Good morning. I'd like to call to order our December 18th, 2019 Left 2 Board meeting. We do have a quorum present this morning, so thank you. I'd like to start off with a moment of silence and remember our fallen brothers and sisters, both in police and fire. Then on a special note, our sister on our board, Tarina, the passing of her brother. And then also I learned this morning the passing of Ade's brother-in-law. So let's keep our board members, their families in our thoughts and prayers as well. Let's take a moment of silence. Thank you. All right, thank you. All right, we've got a rather aggressive agenda this morning, and starting off with the approval of our November 20th, 2019 minutes. Motion's been made and seconded to adopt the minutes as presented. Discussion? Seeing none, all those in favor say aye. Aye. Opposed? Minutes are adopted. All right, item number 2, State Investment Board Annual Update. Mr. Nelson.
Mr. Chair, today we have with us Teresa Whitmarsh, the Director of the State Investment Board. She'll give you an update on the SIB's activities, and then also I want to do a personal thank you. I've said this every year, but you could not ask for a better agency to co-locate with than the State Investment Board. It's been great working with them again this past year, and with Teresa in particular, as we've had to negotiate our move and some other unusual activities, and she's been fantastic throughout. So with that, I'll turn it over to you.
Thank you so much. Appreciate the opportunity to provide my annual update. I always feel like I'm among friends here. This is one of my easier audiences, so hopefully you won't be too hard on me today. Just a little bit update. You know, every time I come before you, we have even more assets under management. Today we are over 140 billion. I think, Pat, when you were on the board, didn't we reach the 60 billion mark and do a cake or something like that? So it just keeps growing. And, you know, obviously about 100 billion of that is retirement money, which is what you're interested in. But I always like to just give a little overview across the entire portfolio to put some context in how we invest. I think, you know, obviously you understand our mission, and it's basically when it comes to retirement security, our goal, our part of the three-legged stool that ensures retirement security is the investment returns and making money for you. So I think you're familiar with the fact that basically of every dollar that is paid out in pension benefits, the WSIB earns more than 75 cents of that dollar. And sometimes it's even higher, as much as 86 cents on every dollar, depending on market conditions. In order to achieve that goal, we diversify our investments across the globe in a variety of asset classes. And today, the retirement funds comprise more than 14,000 different underlying holdings. So we own essentially a piece of almost everything across the globe. We commingle the assets of the retirement funds into a single commingled trust fund, which gives us scale, and that ensures us access to global markets at a very cost-effective price. So the market value of the commingled trust fund today is about 110 billion, and in addition, we run about 10 billion in defined contribution or the self-directed plans. And Steve asked me to give you a number. Well, you see the left number there. We highlighted it at over 14 billion are your assets that we're managing for you. And 327 million of that is the Left Benefit Improvement Fund. That was the most recent balance on that. Performance over every time period except for 20 years has beat the rate of return that the legislature expects from us. The current return expectation is 7.5%, and as you can see across the top line, the 1, 3, 5, 10, and since inception number all exceed that expectation and fairly substantially in some years. Our outperformance is primarily due to our very large allocation to private assets, both private equity and real estate, which both have registered double-digit returns, and you can see I've highlighted those two rows, both real estate and private equity, and have basically registered double-digit returns in every time period. The board continues to be very committed to private market investing. We just had our annual plans for each asset class presents our annual plan to the board every December. We just had our annual planning session last week, went very well, and essentially reaffirmed our commitment to our existing investment strategy. Our board members, though, are also realistic and enough to recognize that the assets are very richly priced today. That was one of the themes that came through in our discussions with the board last week and with the senior investment staff is there's this concept called the market is priced to perfection. In other words, it's priced as if nothing could go wrong. And we all know lots can go wrong. One of the most basic investment beliefs of the board is mean reversion. So in other words, a simple way of describing mean reversion is recognizing what goes up must come down. So we're cautioning. I had an opportunity to present to the Select Committee on Pension Policy yesterday, and I basically said, don't get too giddy over these returns. Don't start jacking up benefits, right? Because we do not expect that. I know that your whole job is to improve benefits. I understand that. But as you know, there's different ways to pay for benefits, contributions being one that you as a board have always been very responsible in asking and setting appropriate contribution rates. But all we're suggesting is don't think that the kind of performance we have now will necessarily pay for benefit enhancements, because we expect those returns to come back more to a normal rate of return. In addition to looking at our performance compared to the legislature's expectations, we also look at our performance compared to our peers. And we participate in an organization called Cost Effective Measurement, CEM, Investment Benchmarking. And it covers almost all U.S. public plans. And then our particular peer group is about 11 or 12 other public plans that are similar in complexity and size to us. So to explain this chart, the little green dot you see is us. The boxes are the range of returns among the whole universe, with the red line being our particular smaller peer group returns. And you can see, and they do a 5-year running return analysis for us and present this to our board every September. As you can see, we have significantly outperformed both the U.S. public median and the peer median. Getting back again to our preference for private markets and the outperformance of private markets, what this particular slide shows you is what CEM calls a policy return. Essentially, that means what kind of return do you get from your asset allocation. So in other words, the board's responsibility is to set the asset allocation. Staff's responsibility is to implement. A lot of the outsized returns we have are because our board has been very willing to kind of reach a little further out there into the alternative space and have a very large allocation to private assets. And that's what this shows here, is that our policy return, or our return from our bet on private markets, is a significant contributor to our outperformance. The other thing we pay a lot of attention to, and we have CEM analyze, is our costs. And we do run a very cost-effective program. As you can see here, we underspend according to our peers. In other words, the very same services we pay less for. Some of that is due to our size and our ability in the marketplace to have clout and negotiating power. Some of it is due to just very efficient cost management within the WSIB, and some of it is due to our retiring chief investment officer's great negotiating skills. But bottom line, we save about nearly $140 million a year in fees and expenses through our focus on costs. Now to look forward and tell you a little bit about what we might expect in the future. These were the capital market assumptions adopted by the board last spring. And essentially what the capital market assumptions are our expectation for returns by each asset type or each asset class going forward 15 years. Sometimes our capital market assumptions or our expectation of returns differ a little from the state actuary. That's because he goes out 50 years, we go out 15. And there's a little difference in methodology. But bottom line, you can see here what over time, what we're expecting for each asset class. And then you see the standard deviation is the volatility around each asset class. If we go to the next slide, you see that all of those asset classes pulled together into a single mean return for the total commingled trust fund. In 1 year, you see the range of possibility from a maximum return of 46 down to a loss of 22.8. But over 15 years, you see that range compress. It's much smaller, the volatility, and with an expected return of 7.4%. This is slightly lower than the legislature's current assumed rate of return of 7.5%. But again, these are statistical models that are not perfect. And so we don't, we're not going to quibble over a 10 basis point difference. One thing I just want to mention here is the challenge with capital market assumptions is they are statistical models, and they're based largely on past performance over many, many decades. And to a certain extent, the past is prologue, but not always. And so the one thing that we want to caution, again, as I said earlier, pension policy must be forward-looking, and even though we have seen great returns here, we are concerned about the future. We think that returns are not going to necessarily go forward in the same way, and it's for a lot of reasons. To kind of use a sports analogy, there are abundant wild card factors that interact in unpredictable ways to produce widely variable outcomes. You can just think of our Seahawks in the season. That applies to markets. There's geopolitical tensions, there's governance tensions, there's what I would consider a very long in the tooth business cycle, long in the tooth recovery or expansion. Despite the fact markets continue to keep going up, this is the longest expansion ever in the history of the U.S. And there's all kinds of disruption and transformation due to technology. So there's a lot of things that give us pause and make us wonder if we'll be able to continue this going forward. So in light of some of the challenges and some of the expectations of the WSIB, I think one of the things that was really a hallmark of the Great Recession, WSIB's response to that, is the board stayed the course. And Pat, you were on the board at the time, and you know how difficult that was. There were some board members that were panicked, worried that we were in what would be called a new normal. In other words, we'd never see the kind of historical returns we'd seen. So we took the board through a very considered process of looking at our capital market assumptions, looking at our investment beliefs, deciding on what the market outlook was bringing in naysayers, bringing in optimists, and the board ultimately made the decision to stay the course through the crisis, and we've been greatly rewarded for that discipline. So it's interesting because I've been in my role 10 years now, and I sort of feel like this is deja vu all over again. We're working on preparing stakeholders and the board for a potential significant market correction. But again, we're all long horizon, and as long as we continue to stay very disciplined in our investment approach, I think we'll do just fine. So with that, any questions?
Patrick?
Once again, Teresa, when I was on the board, the learning curve was huge. But the team that you've assembled over the years have been just remarkable for all of us. I don't think this board, probably because of the what we deal with on a monthly basis, and the investments, they see it probably more than most. But they really do not understand the usual, the citizens of Washington State, what you've done for them in the way of the investments and what our returns are and what how solvent we are within our pension systems, and that is directly due to your leadership. So thank you very much.
Well, thank you. Gary Brubaker, our Chief Investment Officer, is retiring at the end of this year, and we had a really wonderful celebration for him last week. And one of the numbers that one of our board members asked us to run is if we had just earned the median return during Gary's tenure compared to what we earned under his tenure, what the difference was, and it was over $13 billion of value add. Yeah. So I told him, I said, oh, shoot, I wish we would have got you a nicer retirement gift. He got 5 Hawaiian shirts and an In-N-Out Burger gift certificate.
That's the gift that keeps on giving, though, right?
Yeah, exactly.
I did have one question.
Sure.
I noticed it in some of the one of the slides that showed you had about approximately $1.5 billion in cash. Is there a threshold that you have when you hit a certain dollar amount, the cash then becomes you start to buy, or is it you just hold a certain number in reserves? Just curious.
Yeah, we're rebalancing constantly to. Honestly, I didn't even notice the $1.5 billion in cash. That would be all of our partners combined to what they hold in cash, and we have essentially a zero allocation to cash, but we maintain cash. It's a very sophisticated set of inputs that determine how much cash we need, and it's based on outflows, whether that be capital calls from partners, whether that be just paying out benefits, things like that. So they're constantly monitoring that daily, basically. But there's different periods of markets where some of our managers will hold more cash when they think there's opportunity for like a correction and they want to be able to very quickly move. So it's a pretty complex thing, but we don't actually allocate, we don't have an allocation to cash. It's more to manage cash flow needs and potential market opportunities. The one thing we are doing in our fixed income portfolio, though, right now is we're holding a lot of treasuries, and treasuries are highly liquid. And one of the things we learned in the last cycle is that, you typically think of fixed income bond portfolio as relatively easy to trade, but because of the style of investing in our bond portfolio, which owns a lot of corporates, those were very thinly traded during the recession. And we didn't want to sell them because they were performing so well. So Bill Kennett, who runs our fixed income shop, has been increasing his holding in treasuries over the last several years, and they've actually performed very well. But he's been doing that just so we have what they call a liquidity buffer, an easy source of liquid assets should a big recession hit. So.
Thank you.
Sure.
Yes, sir. But
Well, thank you, Mr. Chair. You know I'm fascinated with our asset allocation just because we're unique. And as I mentioned before, you're known on an international basis, for the job you do. When you talk about market volatility, you talk about governance issues, geopolitical issues, market disruptors, this kind of thing. Would those apply more towards public equities out there, market equities, than they would private equities? And why are private equities considered volatile when in fact most of them are collateralized? And this is like a one-dimensional ignorant question because I don't understand.
Yeah, it's funny because volatility is, it's basically private assets. Historically, private equity in particular will have more volatility. The way we actually invest, it's not as volatile as our capital market assumptions, but some of that's because if you think about private equity, you think of a range from venture, which is highly volatile. I mean, in a fund, $100 million fund that maybe makes 20 investments, you might have 10 or 12 that fail and a couple home runs. In the large corporate finance area, which is where we play, there's not as much dispersion of returns. In fact, it's really rare to actually have a total write-down in a corporate finance portfolio. So it's much less volatile, less risky. But when we're looking at capital market assumptions, we're looking at the whole market, and we're making some adjustments based on our style. But when you hear about private equity being really volatile, it's because they're thinking of the whole spectrum of private equity investments. But the way we invest is quite a bit different. Yeah, absolutely. That was very important for Gary to make in his final board meeting, to note that.
I think she also pointed out that they're doing better now since you've left the board. Yeah, I just want to make sure. You said, all right. Any other questions?
All right,
Thank you very much.
Thank you very much. It's always a pleasure to come before you, and we are delighted that we can serve you.
Thanks. All right, Mr. Nelson, pension funding policies.
All right, this is a continuation, completion of the work that you have been doing all interim long. And we've got Lisa from the State Actuary's Office, and I'll be joining her to kind of go through the funding policies that you've been working on, both with respect to your actuarial cost method and to kind of the funding corridor issue, for lack of a better word. But then Lisa and I will walk through that now with you.
Good morning, Mr. Chair, members of the board. Lisa Wong with the State Actuary's Office. Always a pleasure to be here, and what would a 2019 Left to board meeting be without a discussion of actuarial cost methods or funding policy? But given that, I'm hopeful that we can move through some of the material quickly, but I'm also more than willing to entertain a number of questions. Steve and I will be managing this through our specific roles, so whenever there's motions or discussion of policy, Steve will be managing that, and when there's questions about actuarial stuff, I'll try and help you answer those questions. So today, I've broken this presentation down into the three key components that I think are all before the board for potential action today. So start with a refresher on actuarial cost methods and even get into what that would look like in your actuarial valuation. The funding policies that you currently have in place and any that may be required depending on what happens with item number 1. And then wrap up the discussion talking about managing plan funded status. So again, there are potentially 3 items before the board for action today on each of those 3 topics. So starting with a little background on pension funding, as I mentioned at the beginning, we have talked about this several times this interim, but the basic idea is with pension funding is you're trying to accumulate enough money to pay for the stream of benefits when members start retiring. And that accumulation of those assets is managed through 2 key components. 1, your underlying actuarial cost method, and 2, any board funding policies. Now, one may ask, why do we need both things? You don't need both things, but you absolutely need the first one. So you can have the first one without the second one, but you can't have the second one without the first one, because there are laws that are requiring actuarial certification of work, and that can only be done with an actuarial cost method that's been approved by the profession. So your cost method is just going to determine the required contributions that you need to fund the plan. Your board funding policies, if you choose to have any of those, can overlay that cost method in order for you to achieve certain goals. So in past presentations, we've talked about 2 key actuarial cost methods, the aggregate and the entry age normal. And either of those cost methods can achieve your funding goals, assuming you've got appropriate funding goals for that particular cost method. So why might the board keep the aggregate cost method. So some of the considerations for you in staying with what you have right now is that would be a consistent cost method with all other Washington state retirement plans. The aggregate, if you recall our prior presentations, it rolls all the costs into one rate. So because it rolls all the costs into one rate, there is no unfunded actuarial accrued liability or, in quotes, surplus amount that would separately be identified in your valuation report and would also require an additional policy in order to amortize that. And the aggregate method has provided a solid foundation. That's what the board has been using for, I think, ever since the plan was incepted, and it has been very successful for you. On the flip side, why might you choose to switch to the entry age normal cost method? There is a potential for some increased consistency because one component of that cost method is already in your funding policy. It's the cost method that's used by the majority of public pension plans nationally, and it would also be consistent with what's required in your accounting reporting. So those are the key comparisons between these two cost methods. And what I'd like to do next is go through and just give you a quick snapshot of what this could look like in your valuation. So this table is right out of your actuarial valuation report, and it's the development of your contribution rates. So this is what another reader might look at to say, hey, what are you required to contribute versus what you are contributing? This might be the table that they would look at. And so on this table, we show several dollar amounts, and then if you look at line E, that's where we calculate the member contribution rate. This is under your current cost method aggregate, 6.39. Then we overlay your funding policies, which one of your goals is stable rates, so you have adopted the normal cost from the entry age normal method. That number is 854, so your final member contribution rate 854. So this is what is currently in your valuation report, this table. If you switch to the entry age normal for your cost method, the table would be a little bit longer because remember this has two contribution rates. Aggregate rolls everything into one. So you have a couple more lines of information here. If you can see line C, that normal cost rate looks familiar because that's the minimum rate under aggregate, line F, 854. So that's the normal cost rate, but then we have to calculate that UAAL or surplus rate that is part of this cost method. And that's calculated on line F to be negative 2.57. So the total required contribution rate for this cost method would be line G, 5.97. Now, we had to make an assumption of what the amortization policy is. That would be a decision the board would have to make, what your amortization policy is for that UAAL, how you amortize and pay for that past cost. We just made a decision to use 15 years. If we had used a different amortization amount, something closer to, say, your remaining working life of your current members, that 597 total rate would be closer to the 639 under aggregate. Okay, so they would be very similar depending on your amortization policy. But bottom line is these would be the disclosures in a valuation report, including line D, where we would show 878 million of, in quotes, surplus. Some people would call it surplus. Actuaries have a different definition of what surplus is. But 878 million would be disclosed in your report, and then this negative 257 would also be disclosed. So that's the difference. If you also had, for example, that minimum contribution rate policy continue with this cost method, we would have line H, and then line I would be your final rate, which is the same as what's under aggregate right now. So this shows that you can still achieve your goals under either of these cost methods, you'll just see a little bit different disclosure of information. So that is the end of this topic. I don't know if at this point you have any questions on your cost methods or would like to make any motions or do anything at this point, or if you'd like me to continue through the last two sections.
We'll take questions, right? Any questions? All right, go ahead and continue.
All right, moving on. The next section is your funding policies. So if you'll recall, we've started with your cost method. We've got that in place. Then you can overlay funding policies in order to achieve specific goals. Some of those goals might be the adequacy of your rates, stability, affordability of those contribution rates, which right now you have policies in place for rate stability. You could also have policies that address risk management. For example, one of the things we'll be talking about in the last section is, do you have sort of a surplus or a little cushion in your funded status in order to manage potential risks that could impact the financial security of your plan. So there are policies that you can have to address these types of goals that you may have as a board. As I mentioned, policies can achieve similar outcomes even with different actuarial cost methods. So your actuarial cost method won't determine what you contribute if you apply your policies on top of a cost method. It's just a requirement of the actuarial profession that you have a cost method that has been approved by the profession. So as mentioned, some of the current policies left to achieve rate stability, you have your minimum contribution rate, currently 100% of the normal cost under entry age. You have the asset smoothing method, where we smooth asset gains and losses up to a maximum of 8 years, and you also adopt contribution rates over a 4-year period. So those are all in place to help you achieve what you have determined as one of your most important goals, which is rate stability. And the final component on funding policies is if you do switch to the entry age normal cost method, you would be required to adopt one more funding policy, which would be how do you amortize that unfunded actuarial accrued liability component of that cost method. And this table is taken from one of our prior presentations where we're showing you how that can vary depending on what decision you make on your amortization period, which really just determines how quickly you pay off those past gains or losses and return your funded status to the 100% target. And that is the conclusion of this section on funding policies. If there's any questions.
Go ahead.
Carrying on. The last topic is a little bit more new. We haven't delved into this quite as much as we have actuarial cost methods and funding policies, but we have touched on it, so I am sharing some information that you have seen before. So as a background, your actuarial cost method, it is actuarially determined to achieve a goal of 100% funded status. That's its purpose. And so whenever your funded status drops below 100%, it's going to increase your rates to get you back to 100%. If your funded status is above 100%, your rates are going to start coming down. Again, all with that goal of achieving 100% funded status. That's what an actuarial cost method is meant to do. But because of that, you can have some contribution rate volatility because it is, as experience of the plan comes forth, then this method is going to adjust your contribution rates accordingly. Now, your funding policies can impact the progression of the funded status. So when you have a funded funding policy that has minimum rates, in other words, it's not letting you go lower than a certain level, then that inherently is just going to increase your funded status. Because whenever your cost method says you need to contribute more, you're going to have to contribute more because you'll be above the minimum. But when your cost method says, oh, you can contribute less, your minimum is going to kick in. And so that just means that it's going to increase the funded status of the plan. So your current policies already manage any declining funded status because those contribution rates under your cost method are going to kick in. Whenever your funded status drops below 100%, it's going to kick in and say you need more money. So that's covered. So the only thing before the board is to consider whether you want a trigger or corridor on the upside, because there isn't anything in place when you've got a minimum rate to bring that funded status back down. So that's the piece that we're talking about today. So this this graph might look familiar to you. We looked at projected funded status, which is the medium blue line that is going upwards, and the funded status is on the left-hand side. So you can see the projection out in 2040 is that your funded status, if everything continues as expected and actual experience matches the assumptions, you're looking at a funded status growing potentially to 124%. The orange line, which matches up with the numbers on the right-hand axis, is the minimum contribution rate under that entry age normal method. So you can see the stability of that rate, which is why you're using it for rate stability for your plan. That rate is pretty constant, just under, slightly above 9% member rate. The dark blue or maybe black line is the projection of your underlying cost method contribution rate, and it is projected to decline continuously over this period. So that would be the rate that says this is all you need for 100% funded status. So as your funded status continues to rise, that continues to drop. So that's the projection of what we're seeing. And so one of the things we wanted to talk about, as I mentioned, we don't have to worry about the funded status dropping. Your cost method will kick in and take care of that, bring you back to 100% funded status. So it's just this increasing funded status that is before the board today. So one of the things we looked at was a step-down approach to that minimum rate. So right now, your policy is 100% of the normal cost under the entry age method. So we looked at potentially stepping that down once you hit a certain trigger. And we have the next two slides will show what the projection of those policies would look like. So this first graph shows the projection of two different policies that kick in at 110% funded status. So this is what we talked about at the board offsite and the model that Mitch shared with you, and we got to play with some numbers and run some simulations. So whenever your funded status hits that trigger of 110%, then your normal cost or minimum rate would drop under two different scenarios we're showing here, to either 90% or 80%. And then there's additional triggers at 115, 120% funded status in the event that it continued to increase. So what you're looking at, the black line, is what we're expecting the projection of your funded status to be under current cost method and policies. If you move to the alternate one that drops to 90%, then 80 and 70% for your minimum rate, then you'd be looking at the green line. And that has a ultimate funded status around 116% versus your current policy, which is going north of 120. The yellow line is a little bit a little bit more aggressive change at that 110% trigger, drops down to 80% instead of 90. And so that projection has an ultimate funded status of around 111%. So that's the first set of examples with 110% trigger. And the next set is at 105% trigger. So whenever your funded status hits 105%, then you're going to take a different approach for your minimum rate. Again, the same changes to the minimum rate, 90% under alternate 1, 80% under alternate 2, then a 10% drop for each other increment. But the difference with this graph versus the prior graph is this graph starts to make a change to your policy as soon as your funded status hits 105%. The ultimate funded status for alternate 1 is 111%, and for alternate 2, interestingly, is 105%. And just to wrap up this section, we did take a step-down approach to these minimum rates, again, trying to support the board's goal of stable rates. So tried to take a step down so it wasn't like just a big change from 100% to 70%. So trying to keep it in line with your goals of stable rates. The funded status under all of these options stabilizes at what we consider reasonable levels and still provides a buffer for adverse deviation. So the lowest projected ultimate funded status in all these alternates was 105%. So it ranged from 105%, I think, to 116. And we did measure the risks added to the plan for any of these alternates, and it was very limited. Any increasing risk was very limited. If you recall that table where we ran the simulations and the numbers changed by like maybe 2-3%. So very limited added risk for any of these alternate policies. And that concludes my comments.
Thank you, Mr. Chair. God, I hate asking questions, Lisa. I always express my ignorance, and I know you're looking at me. I get that. I've been married long enough to understand. It's like, oh God, here it
always
comes again.
expect a question from you, Senator.
So when you, from 20,000 feet, here we are in the longest consecutive growth period in our country's history. And even our smoothing corridor was, 7 years, 8 years, this kind of thing. All of a sudden, we're beyond that. We're like 10 and a half years at this point now. And so when you look at the potential downside or funding status, 6 1/2 dozen the other, is it an anomaly out there, a statistical anomaly or an outlier kind of a thing that we actually don't have the history to determine exactly what the potential downside is when the market does cycle, and it will cycle. If you were to take that thought and figure out, I think that we'd be able to handle any market fluctuation over a period of time after such a long growth period here, even if it wasn't a cliff like it was 10 years ago, but it was a steady decline for X amount of period of time. If you were to pick a funding status out of the air that would be able to handle that and hit somewhere in that median of 100%, would you say it'd be like 110, 150, and 120? Just a casual thought on that. What do you think?
Well, so we're at 108, I believe, 108% funded status, somewhere in that general area. And we did run a Great Recession, and from 108, the funded status drops to 85%.
Right.
We also ran, based on, Wolf had asked some questions about, what about something a more reasonable recession versus the Great Recession? So we looked at the 2001-2002 period, including a 3-year bounce back, so a 5-year period. We ran that as well, and the funded status only drops to 95%. So does that mean you need to be at 115 to handle that type of experience? Possibly. I think really it comes down to balancing, as an actuary, I'm going to say, yeah, let's have some cushion, right? I mean, we tend to want to be careful and make sure that we've got some cushion, but I know that you're faced with other issues.
Yes.
And so I think from my perspective, I think the most important thing is that you have a plan, whether that plan is at 105% or 110% or what it is. But I think the most important thing is that you have the story to tell of what you're doing and why. That would be my consulting.
Fair enough, thank you.
Pat?
Elise, thank you, Mr. Chair. As the senator just spoke, I guess sitting on this board, what we do is we actually, we make decisions on the information that's given to us. So I'll figure out a different way to ask the same question the senator did. This
Sure.
is just you. If you were sitting here and you were looking for a comfort, what would you recommend, the 110 or the 105?
I would probably be more comfortable at 110 just because of, my outlook and my position. I would rather be more secure.
And you're an actuary, correct?
Yes.
I understand now.
Yes, I am. So I think that's where I would be, but I think it's just important to be able to say, this is what we're doing and this is why. So when someone sees a funded status increasing, you have the response. This is what we're doing. We saw, for example, if we could look back at, we just modeled the Great Recession, right? And we saw, maybe a 20% drop in your funded status. So, but a more, reasonable recession, like the 2001, 2002, we're seeing maybe a 10-ish% drop. Maybe that's your story, right? We want to ensure we're protecting against this type of situation so our funded status doesn't drop too far below 100 if it drops that much. I mean, that might be your story. So I just think that it's important to have the plan in place as this is unfolding so that you can tell that story and support the decisions that you're making. You've made incredible decisions for this plan.
Well, we've discussed this before. We're pretty well set if the worst case scenario happens. What we're trying to do is trying to lock in on when we have the best case scenario. And so we don't get ourselves into 124%, because once we get up any higher than what we are now, there's people looking at us right now. So what we're trying to do is come up with a formula. So if we kicked in the 105 and all of a sudden we had the tech recession, the 2001, 2002, it took us less than 5 years to regain what we lost. And we have checks and balances in the market if we take a recession, versus we need that one that we don't want to get too much higher than what we are now. And you'd be comfortable at 110, but we would, if we dropped it to 105, we have those checkpoints, those markets that we could, that the funding would not drop. We would go right back to our situation of increasing our, without the big drop, without the big bite. If
Yeah, so let's say,
making sense, I'm trying to.
I think so. Let's see if I can kind of play that back to you. So if, say, for example, your policy is 105%, and so that's where the plan is. Say the plan's hovering around 105%, and then we have a 2001, 2002 experience. Then that funded status will drop, and probably 10 to 15%, so maybe down to 90, 95% funded status, and then your underlying cost method will get you back. It might take 5, 8 years, but it will get you back. So it will automatically get you back, and then once you get back to that 100%, then your minimum rates start kicking in again because they'll be higher than your cost method.
Okay.
And you'll start getting back to the 105.
Thank you.
Change it to the 10%.
Yeah.
Yeah, let me put
When
those
you
back
say
up.
get you back, though, I mean, are you looking at a 10% member contribution rate at that point, or is it going to be in that 8.5% range?
That's a great question, and I think it's about 10%. I think the example we ran for the 2001, 2002, just a little north of 10% member rate would be required to get back to that 100%
So if a
funded
recession were
set.
to hit, maybe you're paying 6% for a while, but then it goes to 10%, or you could pay 8% over that whole period and be at about the same spot, possibly.
I'm not sure if the 8% is what your
Well,
your
the
minimum rate.
Right. If you paid the minimum rate the whole time, or
Right.
you could pay 6% for a while, and maybe if there was a recession, you have to pay 10% for a while. In the end, it might have been that you just kept paying the 8%, you'd be in the same spot.
Kind of. Similar. No, I see what you're saying, but when you're paying, so I think what you're asking is if you didn't have that minimum rate and you were just paying the cost method rate, 6% is about what we're seeing right now. The difference is because you have your minimum rates, you've got more money coming in right now than the 6%. So I think you, because of your minimum rate policy, I think you're further ahead than if you were doing 6% and then have to hit 10.
Quick
Because I think
yeah.
you might be at 10 for a little longer.
I appreciate that. The other question, it looks like at both the 105 method and the 110 method, there's alternate options that both land us at about 111% funded rate. One is if we chose alternate 2
Yes.
with the 110%.
Exactly.
Alternate 1 at the 105. Are you saying that's the 110 you're comfortable with, or the 110 policy? I'm trying to figure out what you're explaining there.
I think if I was on the board and making the decision, I think I would probably be looking at this set of numbers, the 110% trigger, and then whether you go alternate 1 or alternate 2, that would be probably less important to me than the first decision. Are we targeting a funded status trigger of 105% or 110%? And then once we do that, what policy do we put in place? Maybe the 90, 80, 70 is less of a change to go from 100% down to 90 versus 100% down to 80. That's a bigger drop. I think we showed that right here.
Question, Lisa. I think I know the answer to this, but I'd rather ask than be wrong. Whether we accept an aggregate cost method or early age normal, regardless if we choose 105 or 110, there's no effect, correct?
I don't know, because the 105 or 110% trigger will be on that minimum rate, and that minimum rate can be in place under either cost method.
Thank you.
Yes.
All right, I got a question as well. So if I'm looking at the 110% under alternate 1, where when it goes in place, and it looks like by the graph it would kick in because we've already adopted rates out for a period of time, about 2024, correct? Right in there, is that right?
Yeah, it might be 2022, but yeah, somewhere around there.
In that
Yep.
time frame.
Yes.
So that number being above the 110, we would drop to the 90%.
Correct.
Okay,
So your minimum rate would now be 90% of the normal cost under entry age instead of 100%, which used to be your minimum rate.
And my question, this is where I got a little confused, is that in that time frame where this would kick in, it appears we're above 115%.
Yeah.
So it would go to 80.
Yeah. Can you show the 105% slide? One of the points that Lisa made earlier, and look at the green line here. That's the alternate 1 where you would go to 90%. So your member rate which is currently 8.5, would dip a little bit below 8, 7.75, somewhere around there roughly. Okay. You can see because you're at 108 now, but you've got those deferred gains on the books. You are projected, you've got rates set through 2023. You're going to go from 108 up to about 116. The actuary talked about that in October. So if you're looking, you're kind of talking two different things, both the long term, what are things going to look like, and cushion against a recession. If you take into account the deferred gains, for instance, if there's a recession, a normal, a 2001, 2002 recession between now and 2023, you're probably still going to be at 100% funded. That'll take care of the deferred gains plus the 108. Also, long term, you can see under that, you peak up, but then you're at 108 now. In 2040, you'd still be at 112. So even with, so if you're trying to balance those two different goals, some of you said earlier, if we get any higher than where we're at now, there's a target. You're going to get higher than where you're at now under either of these approaches. One of them, the 90% here that you see at 105, keeps that high end from 116 to 112. And if we go to the 110%, it goes from 116 to right around 116 again. So under a projected scenario, if you're comfortable being at 116% funded and as far as the target goes, then the 110% trigger with the alternate one would work for that, and you'd have a 15 to 16% buffer for the next 40 years for any recession to keep you at 100%. If you do the 105% trigger, option one, you see you still are almost at the same place, only instead of the high end being at 116, the high end is at 112. So the difference between the two and the cushion between the two for the next, until 2023, you've already adopted rates and you've got those deferred gains on the books. Neither of these alternates is going to change anything between now and 2023, at which point in time you'll be adopting rates.
And just to answer your specific question, Dennis, I think that's correct, but I am going to look back at Mitch and make sure that is correct. Yeah. Yes.
So I'll stare at Mitch.
Yeah.
So just to make sure, so if this kicked in 2023, we wouldn't be at 90%, we would be at 70%.
80.
Under-
Which one? We're looking at the 105% trigger or 110?
110, sorry.
110, yes. 80, yes.
Is there
If that was your motion.
Correct.
is there a step down you were talking about though? Would it go directly to 70 or would it be like?
Is it done through each budget?
That is all the board's rate adoption decisions and discussions. I think this would be, and you could make those decisions. So, for example, if this was the policy you chose, say alternate one, 110% trigger, and we come to that first time when it would drop, you may decide, well, we're going to step into it. So you still have that, but I think this is your outline, your template, for the decisions you make. But in the moment, you can still say and the other thing too is that our office can bring you projections that help you see, yes, is that what we should be doing right now, or do we see maybe an increase coming? So we're not gonna go all the way to 80. But this is just the framework that you're setting for your funding policy, if that makes sense.
Mr. Chair?
Yes, sir.
Let me see if I can, I'm kind of focused in on the 105 for a certain reason. We're at 109% funded now. If we decided to go to the 105 alternate one, but with doing that we transfer another 350 million over into the benefit side, the enhanced benefit side, that would drop us from 109 down to about 106%, give or take, because each 100 million is about 1%. So if we're able to capture that money over into the enhanced benefit side and drop it to the 105, we'd be on target to have those numbers pretty much smooth themselves out as we go. We'd have that money in the reserve. We'd also have the deferred of the account. Plus, we'd be looking at 105. We'd have like maybe a year or so, or whatever it takes, before we kick into the 90% side of it dropping. So now we're getting a benefit from all sides. The money comes into the enhanced side. Our rate will drop. The employer's rate drops. The state's rate drops. So everybody gets a bite of the apple. And in this way, it smooths our points down. We cut out the high mark to where we go from 109 to 113 to 115%. And we don't have people shooting at us. And I think that's, to me, that if we can get there, I'm not sure if this is the day we do it, or if this is where we discuss it, or we can even transfer money into those accounts without certain help. But it does give us everything what we need as a pension to make sure we're maintained until at least 2040. And I'm doing the math on how old I'll be. I'm okay with that. So
117, I added it up.
so that would be my input there. I would go, if we could transfer money into the enhanced account, I'd be willing to go to the 105%. The 110 still puts a target. I think the 110 puts a target on us. Funding.
Mr. Chair.
Go ahead.
I'd like to go ahead and make a motion. I guess it'd be a two-part motion, or I don't know if I need to split these up, but I make a motion to stay with the aggregate cost method for our funding, and I'd like to make a motion for 105% funded status with the alternate one trigger.
Okay, those are two motions, though.
Okay.
Let's do one at a time. Yeah.
Okay.
Let's start with your aggregate.
Yeah, so my first motion is to stay with the current aggregate cost method. Excuse me, cost method.
Motion's been made and seconded to stay with the current cost method aggregate. Discussion on that. Seeing none, all those in favor say aye.
Aye.
Opposed? All right, motion is adopted. Second.
Mr. Chair, my second message was, our motion was to stay at the or to adopt the 105% funded status with the trigger one alternate, as described on slide 12.
Second.
The motion's been made and seconded to adopt the 105% funded status trigger, alternate one, that would be the breakout, as you noted on slide 12. It's been seconded. Discussion? Go ahead.
Thanks, Mr. Chair. I'm following Pat's thought process here, and in a term that appears to be a term of art that I've railed against forever, has to do with intergenerational equity. The people that have currently contributed at the 90 and 100% level to build a fund to the percentage of the status that it is now are the people that should benefit, say, for example, from an equity transfer to the benefits trust fund, the separate benefits fund, as opposed to the people that will realize the benefit of an 80 or 70% contribution rate as their funding status continues to increase, and yet will receive over the term of a career the same benefit that we're going to receive here, having paid only 70%, of what we'd paid into the system at this point. So although I rail against it most times, this appears to be a step towards generational equity that we've talked about on the board here, trying to maintain over a period of time that would almost be right in front of us, hard to miss. So,
Patrick?
I'm in favor of the motion, but are we going to be able to transfer any money into the enhanced once we do this? And how do we do that?
That requires legislation.
yes.
Okay, it does.
Yes.
Right.
Is there a discussion we can have with them? I mean, we want to pass this, or I would say I would like to pass this, with the idea that we may be able to move the legislature to agree to another transfer of LEP 2 money into this enhanced benefit that's already there. And that would be legislative. We're going to have to do this now, but with this in our pocket, would the legislature be willing to move that money? And I think that's a lobby.
Yeah, there's no way to answer that question.
Right. So we
as
do
far
this in
as-
good faith, and we said, I'm willing to do this one with the idea that we're going to go in and trying to get another transfer into the enhanced benefit. That is my reasoning for voting for this motion. So if we can do it, we can do it. Oh, Mr. Berquist? Representative Berquist? You'll give it to us, won't you?
I mean, the other thing to do would just be to lobby for approving an enhanced benefit, not transferring more money into it. Being able to say, okay, here's the policy that we were looking for to enhance our benefit. Maybe there's a $300 million cost to the current members, but to maybe give back to the former members, because maybe there's a $600 million overall cost. It's possible that we could argue that the legislature approved that as we're lowering rates, something like that.
So we have an angle.
I don't know if that makes sense, but
That does.
Okay.
To me, it does.
I'm sure the stakeholders would be interested in working on that, so, yeah.
Yeah. To segue off Representative Berquist and what Pat said, I think that is the way forward because the law has changed. There's no automatic benefit improvement contribution from the state anymore. That law's changed, and then we now have the past practice of what we just incurred as far as how do we get a benefit improvement. So I think the way forward is lobbying through our stakeholder groups.
Pretty much we're all in favor.
I think we're all going to continue. Yes.
Mr. Chair.
Yes, sir.
Follow-up. Thank you, Mr. Chair. The reality is that I spoke on the floor when this happened last session here, and there's some resistance about this whole idea until you explained that there's a potential liability that we were avoiding as a state here for our failure to fund according to pre-existing statute out there, and that we're funding it out of our own pocket, so it's an easy way out. Everybody walks away, somewhat satisfied. They were pretty clear that this would be a one-time operation. This probably is not going to happen again. So to address this just from Pat's idea here, yes, there's something that you'd have to play with the legislature, you'd have to lobby for. But then again, at the same time, what we actually recommend for policy or legislation coming out of here as a body will impact, exactly what they're expected to produce, and quite frankly, have a larger footprint out there, because as we reduce the contribution rates, everybody, state contribution rates, employer contribution rates, I mean, there's a lot much broader footprint that would benefit from something like this than just our requesting something like this. So, yes, that's a lobby aspect here, I get that, but also recommendation out of here that as a result of something like this and the reduced contribution rates here, and as a matter of generational equity, that we as a board recommend something like that, recommend legislation to accomplish this. That would also be under consideration. Just a thought.
Ade? Sorry, Mark.
I think when we're talking about a benefit enhancement, the impact depends on what type of benefit, and that may actually affect the funding ratio. So I think caution needs to be taken. Yes, we want benefit enhancement, but depending on the type of benefit enhancement, it can, all this proposal that you have in here can be all totally different depending on the benefit. Is that correct?
Well, yes, depending on what type of benefit improvement goes forward, it can have an impact, obviously, on the liabilities and then the funded status of the plan. We can certainly price that, an option for you, a proposal. If you have something, we do that work even during session. So if you're trying to look for something, we can do some analysis and show you what that immediate impact to the funded status is.
I guess, Mr. Chair, my caution is we need to be careful because whatever it is that we push, well, we are pushing the legislator to do this. Depending on what they do, it may change all the potential liabilities and all of that. And without thinking all of those things out and just pushing them to do something, it may actually have a different impact than
I think that,
actually intend.
just to make sure we're all on the same page, one, we're adopting a policy for our left two board. This it's not legislation. This is
That's correct. This is board policy.
board policy.
That does not go
Correct.
into statute.
So we are not going to change the way the amounts we collect. This is our guideline as a group. And as Pat mentioned, I mean, at some point down the road, if we don't see that this policy is working in the manner we thought it was going to be, we bring it back for reconsideration, we talk about it, and move on. And so I think right now, we have, I'd say, some comfort. I understand the other part of that. I totally get it. I think that is outside of the scope of, or at least this part. I think they work together. As Jason said, it's kind of the elephant in the room. We know it's there, but I'm not sure, because since we're talking about a policy internally and not on the outside, I'm not sure how we could have a policy that would require the legislature to do anything.
No.
Okay.
That's not what we're talking
Yeah, just make sure. Yeah. Okay. Go ahead, sorry.
So I'll speak in favor of the motion. Yeah, and there's a lot of other considerations that we're talking about but not implementing or unable to implement unilaterally as a board. But I think that I look back to the sort of our bedrock principles, which are contribution rate stability, improving the benefits for the members. That's other pieces of our policy. How we can move those other agencies or the legislature itself to agree with us on some. I think that that's a strategic discussion to have in the future. But I do think that there's a potential for, if we're responsible and conservative with the money and how we operate and the rate structures that we adopt, there's possibilities that I can see in the future for all three contributing entities to benefit from that. So, it's members put in 50% of the total cost, employers 30%, the state puts in 20%. I don't think it's beyond reason to have informed decisions in the future that will allow all those contributing entities to benefit if we're based on income and also based on the conservative nature of what we've been doing for the last 17 years. But those are kind of discussions for the future, but I think this sets us up to continue to be responsible and to put all the entities in a position to benefit in the future.
Other discussion? Seeing none. On the motion to adopt the 105% rate alternate one, as noted on slide 12, all in favor say aye.
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 Opposed? Motion is adopted. Thank you very much.
Thank you.
And as far as the other item, we'll just let it sit for a while and percolate. There's 3 points of that. But we had the aggregate, which was done. Correct, that's what, yeah. It's kind of the way I understood it, too. All right. Mr. Nelson, looks like we're on item number 4. Jacob.
Yes. So we'll have Jacob come up here. As you'll recall, the legislature tasked the board with studying the legal, financial, and policy implications of allowing tribal law enforcement officers to join Left Plan 2. And the board has had a couple of presentations from Jacob throughout the interim on the development of that study, and this is the final report on that study. And with that, I'll turn it over to Jacob.
Okay. Good morning, board members. For the record, Jacob White. Steve stole most of my first slide here, but so I'll skip over that. But the report is due to the legislature January 1st, 2020. The board has received 2 more in-depth presentations on this subject. This final presentation, I'm going to try to keep it high level and review the key findings of our research. Also, we'll go over the fiscal analysis that was provided by the State Actuary's Office. So the final report contains an executive summary which serves as a checklist for the major issues that policymakers must make to decide in any legislation allowing for tribal police officers to be members of Left 2. We've covered these issues in depth in previous presentations, so I'm going to go over each of them briefly, give you an opportunity for any questions. So the first decision is how to properly mitigate the risk of Left 2 losing its governmental plan status. So this was really the greatest risk we identified in our research and through our legal advice we received from outside tax counsel. One commercial tribal employee being enrolled into the plan potentially jeopardizes the plan's status under federal law. However, the IRS is very clear that tribal law enforcement is not a commercial activity. So employers and DRS would not need to be as concerned with the multi-part IRS test that I walked you through a few times in prior presentations. That's used to determine if tribal employees are in fact considered governmental or commercial employees. The one main issue that ICE Miller, our outside tax counsel, really directed us towards was that it was very important that the police officers be on the police department's payroll, not any commercial payroll. That payroll is one area that the IRS would definitely scrutinize and look at. So to ensure that there's no issues with this, DRS must have the ability to audit the employer, the tribal employer, and enforce the laws, rules, and regulations of the plan. They would do this through a tribal compact with a limited waiver of sovereign immunity, which allows DRS to do all of this. And I should add, the waiver is not just needed to enforce this one issue regarding commercial activities. It would also be needed to enforce all the other laws and regulations of Left Plan 2. The second decision would be, should limited authority tribal police officers be eligible for a different retirement system? So existing law allows a path for tribes to have their officers be general authority under state law. They go through the CJTC for training and certification, and then there's a separate process with the Department of Enterprise Services who tracks which tribes and which tribal officers are certified as general authority. Tribal police officers are considered limited authority if they have not met this criteria, and limited authority officers are currently covered by the Public Safety Employees Retirement System, PSERS, instead of Left 2, or at least most limited authority officers are covered by PSERS, not Left 2. I think there may be some that are in PERS. So allowing limited authority officers to join Left 2 would be a significant change in policy for the plan and would likely lead to other types of limited authority officers requesting to join Left 2, which has occurred in the past and was one of the reasons for the creation of PSERS. Therefore, the legislature would need to determine if limited authority officers, tribal officers, should be eligible for PSERS or PERS, and PSERS and PERS laws would need to be amended similar to what would need to be done in Left 2 to allow for this, if it is something that the tribes were interested in. The third decision, should tribes be allowed to opt into membership in Left 2? Under current law, employers meeting the definition of a Left 2 employer are mandated into membership. From our survey with the tribes, we know that not all tribes are interested in joining Left 2. And so this would create an issue related to tribal sovereignty, as the state could not require a tribe to be subject to the requirements of Left 2 without the tribe agreeing to a waiver, a limited waiver of sovereign immunity. So therefore, if only the tribes that are interested in joining Left 2 are willing to sign these waivers through tribal compacts, a law would need to be created that would allow for an opt-in process. There is a precedent for this in other retirement plans in the state. So we talked a bit about tribal compact schools that are just in recent years have been allowed to join TERS, and they are the only TERS employer that has an opt-in process. However, this would be a change in Left 2 policy, and it could potentially open the door to other employers wanting optional membership. However, I would say there's a pretty clear line between tribes who have sovereign immunity and other employers who do not. The fourth decision would be, should a tribe's decision to join Left 2 be irrevocable? So there's a financial risk to the plan if tribes join Left 2 and then determine they no longer want to be members. Currently, Washington State, all of the Washington State pension systems do not allow for withdrawal. If there are other states, but Washington is, it's similar to the majority of states do not allow for employers to withdraw, but there are states that do allow for that. If tribes are allowed to withdraw, the law should identify what the process and liability of withdrawing from membership includes. Like I said, there's precedent in other states, and there's also precedent in private sector ERISA plans. And ERISA actually has a procedure, kind of a minimum procedure that needs to be followed for withdrawal, which includes calculating withdrawal liability. And that's typically other states that allow for withdrawal kind of piggyback on that ERISA law and follow it. If withdrawal is allowed for the tribes, it should be clear regarding members not having Bachenhouse rights. This was an issue raised by the board. Bachenhouse or contractual rights to continued membership in Left 2, so that members, tribal officers whose employers join, they join membership, then their employer leaves. It needs to be clear that those members do not have a continued right to stay in Left 2, even though their employer has opted out. There was a similar concern with the tribal compact school. And so there was language in the tribal compact law that addressed this, so that would be useful to any law allowing for tribal law enforcement officers to join. The fifth decision, should the state pay a percentage of contributions for tribes? This one is very straightforward. The law would need to address what percentage the tribes pay. Most Left 2 employers, that's 50% member, 30 employer, 20 state. However, a couple of the newer employer types that have been added to Left 2, port districts and higher ed, that was split 50-50 with the state not paying contributions. And the sixth and final decision, should tribal police officers be able to purchase retroactive service credit? We included this one because it's a topic that usually arises whenever a new employer joins a state pension system, not just LEF. And should the new members have that ability to purchase their past service credit? The concern here is that if the legislature does allow it, the law must address who will pay the full actuarial cost of the benefit in order to limit any financial impact to Left 2, or at least to be clear if there is a financial impact to Left 2, that it was an intended impact. Typically, the member pays the full actuarial cost in these situations. However, there have been instances kind of all over the board with how that's split up between the member, employer, and the pension plan paying some portion of it. So the request here would be that the law is just very clear about what is intended if this was allowed. So we asked OSA to look at the fiscal impact of allowing tribal police to join Left 2. Their analysis was based on the survey the Left 2 staff conducted from reaching out to the tribes. The hypothetical group that OSA priced is comprised of 100 members with the average age of 40 and the average compensation of $72,000 a year with 10 years of experience. Since there's no proposed bill language, OSA and Left 2 had to make assumptions about what the bill language would be. And so if the bill language was different than that, it could impact the analysis done by OSA. So in their analysis, they identified a rate impact of 2 basis points to the employees and 1 to the employer and 1 to the state. This was based on a $20 million impact to the actuarial present value of projected benefits. The impact would be less if fewer than 100 tribal officers join the system and more if more join, and it would also be less if the salaries were less than $72,000 and more if the salaries were more than $72,000. So the next steps for the board is to hopefully approve the final report to send to the legislature. And if I can answer any questions for you, I'd be happy to do so. Thank you.
Do we have questions for Jacob? I know we had, and I apologize, I'm even have my partner try to read this here. Is it William Lasher? Am I close? I believe his signed in has requested just to make some comments on this issue. And I appreciate you being here. If you would, just go ahead and introduce yourself.
Good morning. I'm William Losher, Lieutenant with the Puyallup Tribal Police Department, and I'd like to thank you for your time. Councilman Tim Raynon for the Puyallup Tribe was unable to attend this morning for other work engagement. Myself and Lieutenant Berries are here. We'd like to thank you for your time to study this issue and consider our request. We value everything that you've done. Councilman Raynon has expressed that he values tribal police, our responsibilities to protect our communities, and he feels that providing tribal officers with comparable benefits as non-tribal officers are receiving will allow us to recruit and retain good police officers, to continue to allow us to make our communities safer, and also our officers. Thank you very much.
Thank you. All right, so before our group is the approval, the final report to send to the legislature, and our action is basically to move it on. Been moved and seconded to approve the final report and send it to the legislature, which I believe is due January 1st, 2020. Discussion? Seeing none, all those in favor say aye. Aye. Opposed? All right, motion passes. Thank you. Thank you, Jacob. You want to go into PEB? We got a little time still.
Yeah. So, Jacob, item number 6 on the agenda, PEV coverage for catastrophic retirees. Again, this was the board asked that this come back for a final presentation at the December meeting. With that, I'll turn it over to Jacob.
Okay. For the record again, Jacob White, staff to the board. The issue here is Left Plan 2 catastrophic disability retirees and their survivors have different medical insurance access than survivors of members killed in the line of duty. This issue has been brought to the board over the last few years by catastrophic disability members as a possible solution to issues with accessing affordable health insurance coverage and as a question of fairness as far as should in-line of duty death survivors have different health care access than catastrophic disability retirees. And the issue's also been brought to us in our meetings we have with Department of Retirement Systems. They hear from frustrated members trying to find health care coverage and go through the reimbursement process. And so, yeah, they also brought to us as a possible solution. So quickly, line of duty death benefit. Survivors are covered by PEB and their premiums are paid by Left 2. Survivors do not have a choice to get different health care coverage and have those premiums reimbursed by Left 2. For catastrophic retirees, their healthcare premiums are reimbursed by LEF2, and they do not have access to PEB unless their employer offered PEB prior to them retiring. Retirees have, under this option, retirees do have greater choice. However, it's unlikely that they will find options on the open market or through their employer that are viewed as favorably as the options with PEB. Here's just a quick slide that shows the medical plan premiums for PEB. Some legislative background. In 2009, the LEF2 board proposed a bill which included catastrophic disabled left Plan 2 retirees having access to PEB. At that time, we're going to talk about this just to highlight the fiscal note and provide you an updated fiscal note. But the Healthcare Authority's fiscal note was for $4.7 million for the 13-15 biennium. And the 2009 legislation was for the implicit, what they refer to as the implicit cost only. So that's the increased cost of adding catastrophic disability retirees to the PEB risk pool, not for the explicit cost of actually paying their premiums. That benefit was actually adopted the next year in 2010. So we're not looking at that. So just the other week, we did get updated cost from Healthcare Authority. They adjusted the assumed number of new catastrophic retirees. So on that previous slide, I highlighted that they had assumed there would be 14 a year. But the experience rate that OSA uses has been 4.5, and then the actual experience has been 3.9. So they adjusted that down to the 4.5. However, due in part to the increased number of existing catastrophic disability retirees, back when they first looked at this in 2009, there were only 4 catastrophic retirees. And now there are, I believe, 58, or maybe, I think we have 2 new ones, so I think it's up to 60 now. The estimated costs have increased to $7.8 million in the first biennium of coverage, and then those ramp up to $15.6 million for the 25-26 biennium. I should highlight there, like I said, we just got this analysis, so I've been reviewing it, but not had a lot of time to work with healthcare and to engage the state actuary's office with it. But it did appear as if they have assumed that no one will die. They keep just adding people, and there is no. Yeah, it's some good healthcare coverage that PEB has. So I think there could be some back and forth, and there may be some minor changes for the in this analysis. And then also, we did not have time to identify to work with OSA to identify what the rate impact of this cost would be. However, we did work with OSA for them to do an analysis of, to do an updated analysis of the estimated cost to provide catastrophic retirees PEB healthcare premium reimbursement. This is for the explicit cost. And so this analysis is for reimbursing, so the members are already being reimbursed for their healthcare coverage that they've found on the market. And so this is for their healthcare coverage of switching to PEB, and would there be an increase or decrease in that? And so I do need to talk about some of the assumptions OSA had to make. So the costs were based on the following key assumptions. All eligible retirees would choose a uniform medical plan, which is the most popular plan choice for retirees with post-retirement medical through PEB. And then they also assumed that 1/3 of all retirees would have single coverage, and the remaining 2/3 would be married and cover their spouse and children. And so with those assumptions, they found that there would be a potential rate impact of 3 basis points for the employee, 2 for the employer, 1 for the state, and then have some of the budget cost there on the right. 0.6 million for the 2021 and 1.3 for 21 through 23. And so that is in addition to the costs identified by Healthcare Authority. So the policy options in front of you today: option 1, PEB coverage for catastrophic disability retirees. So this would be catastrophic disability retirees and their families would be covered under PEB, the same as line of duty death survivors. And then option 2 would be no action at this time. And like I said, a lot of this analysis came in the last week or two, and so the board could direct staff to continue to work with OSA and Healthcare Authority to further analyze these costs and to study them for next interim.
Mr. Chair.
Yeah.
Go ahead.
No, I'd like to make a motion for option 2 to continue to study. Given the circumstances that it's all fairly new, I think there's a lot to digest. I know that some people could be helped by this, some people could be hurt by this. I'd like to have more data before we make any type of decision.
All right, motion's been made and seconded to option number 2, no action this time, but would still have some information coming back. Something we work on the interim.
Okay.
Discussion? Seeing none, all those in favor say aye.
Aye.
Opposed? Motion's adopted. We got time to do number 7? Yeah, let's look, I know because Iday's got to leave by noon, correct, Pat? So let's just take a very quick break, get some food, and we'll come right back in. So a couple items to work on. So we'll give us about 15 minutes or so. All right, I'd like to call our meeting back to order.
Mr. Chair, I have a question.
Question?
Yeah.
Go ahead.
I would actually like to reconsider the motion that we made on the pension funding policies, yes.
To reconsider would be in order.
Steve, is that, and I have what, do we need to make the motion first?
Yeah, you have to
Motion's
have a
first.
motion and a vote on it.
Okay.
Motion discussion.
So motion to reconsider.
Motion to reconsider is in order. Those voting, or those supporting to reconsider item number 3, the pension funding policy at 105%, which we discussed earlier, say aye.
Aye.
Opposed? All right, reconsideration, let's bring it up.
So Steve, when I was looking at that, it looked to me, and I know this question was asked, but I don't think it was the answer was clear enough. If we approve the 105% marker,
Yes.
does that mean that in 2024, we would immediately go down to 80%?
That was one of the questions that was asked, and I think the answer was yes.
Okay.
It wasn't under, the motion was to approve alternate 1 on page 12. And so you'll see alternate 1 on slide 12. Under that policy, if you are at 110%, the rate drops down to 80% of the normal cost, and you are projected to be over 110% in the next rate setting, next time you guys adopt rates.
So I think we as a board had only discussed really setting that floor at 90%, never going below, and not going below that. And so if we could, I don't think we want to go to 80%. Is that the general
I can
feeling?
say,
Okay.
I can say no.
Okay. So I'd like to make a motion then about this. Is that?
A motion will be in order, brought for reconsideration.
Okay. If the funding status of the plan exceeds 105% as measured in the most recent actuarial evaluation, the board shall adopt rates at the next rate-setting cycle for the ensuing biennium equal to 90% of the normal cost component of the entry age normal cost method.
Motion's been made and seconded. For simple terms, alternate 190 only.
Correct.
At the 105%. Discussion? Mark?
Sure. I'll speak in favor of the motion. I think it's the conservative, reasonable thing to do at this point, and it's a policy. It's something that we can look at as we go forward, but I think
managing expectations from all the stakeholder groups is probably the most conservative, reasonable thing to do, so I support that.
Senator?
Thank you, Mr. Chair. Also speak in favor of this. The more I think about it, as we are 10 years and change into an economic growth cycle here, the economy is going to cycle on this, and we're not doing something this on the front end of a positive cycle, and we know we're actually going to have an adjustment. I think that it's not just something that would index well or the optics in front of us look good. I think it's a prudent course of action here in consideration we're probably going to be over the next 5 to 10 years.
Thank you. Other discussion?
Yeah, I think, this is a good first step, and should we look at this again in 2023 and see different options on the table, I think we can make them at that point, but this is the good, I think, prudent first step that makes the most sense, is reasonable for a start on this policy.
Seeing no other discussion, all those in favor say aye.
Aye.
Opposed? Motion is carried. The motion, Tor, for the record, is just dismissed, just because it went away. I know we did for reconsideration. I just want to, how we track that or what we do. Sorry, buddy, got you the mouthful, I know.
My apologies. Yes, it's my understanding that a motion to reconsider a previously taken action nullifies the existing action. So the only thing in my mind was whether or not it required a majority or 2/3, but since you are unanimous, it doesn't matter.
Good. Thank you, Tor. All right, back to our agenda. Thanks, AJ and group, for that. We are looking at item number 7, which is the survivor option re-election. Jacob, did you get some food? Okay, sorry. Got you hopping.
Okay, once again for the record, Jacob White, staff to the board. The issue here is that members must make an irrevocable decision for a survivor benefit prior to knowing exactly what their pension benefit will be. This decision cannot be changed if a member's benefit is either incorrect or not incorrect, if their estimate that they receive from DRS is incorrect at the time they retire, or if their benefit is recalculated post-retirement due to many different issues that could occur, either typically an audit or some sort of recalculation based off of service credit or earnings. So the question is, should members have an opportunity to change their survivor option after retirement? There's 2 windows the board has considered. One is immediately after retirement, which I explained a little bit already. And so that is when someone's getting ready to retire, they go through a process with DRS where they get estimates of what exactly their pension will be. Often their pension is typically a little different. Sometimes it can be more than a little different than what was estimated. So should they have a window immediately after retirement to change that option? And then the second window that's being considered is after a recalc has occurred. And like I said, typically this is due to an audit or something where the employer reports new data to DRS, which shows that the pension that a retiree has been receiving is either too little or too much. Should they have the option to change that, have a window to change their survivor option at that time. We'll go over window 1 first. Window 1 is pretty straightforward. We had OSA look at a 90-day window. So this was after receipt of your first retirement check. A 90-day window starts for a member to change their survivor option. They could choose, they could change it to any of the JNS, the joint and survivor options, or a single life option. And OSA does not expect there to be any material impact to left 2 under this option because the window is so soon after retirement that it doesn't really allow for a retiree to gain much more information that would have a anti-selection impact. So they couldn't gain that much more. They're likely not going to find out that their long-term health status has changed in that first 90 days after retirement. Second window, I've got a few slides on this, a bit more complicated. Just start off by saying the cost is unknown at this time, but I'll have some more detail about that in later slides that OSA helped with. At the last meeting, I did share some new data from 2018 from DRS, which highlighted some of the impact of recalcs on retirees. And so just, like I said, shared this data at the last meeting, but just one more time to go over, there were some, I had been over the last 2 years sharing data with you from DRS, and we discovered that there were some issues with that. The data parameters that DRS had used were only for fiscal year 2018 for members who retired in fiscal year 2018. So we had thought it was for everyone in fiscal year 2018 that the recalc had occurred then, but it was limited to only those who retired in 2018 and then had a recalc done in 2018. And that had a pretty dramatic impact on the data we got. So using the correct data, it showed that so the previous data showed only 18% of recalcs resulted in a decrease to members' benefit, and the new data showed that 80% resulted in a decrease to a member's benefit. The largest amount of change in a monthly benefit was $507, and the largest percentage change in benefit was 16.35%. And I should add that for this cost analysis, this is a real small, even though it's a whole year, it's still a small sample set, and it could vary greatly year to year. We did not have time to go back with DRS and to look at a larger sample set of 5 or 10 years of recalcs and to see how that impacts this data. So the underlying issues of recalc clearly go beyond survivor election. Employer errors reporting earnable compensation impact members through taking reductions to pay back their overpayments, and then reduction in future payments. So often you just think of it as there's been a recalc. Typically these are due to earnable compensation errors that the employers report to DRS. That not only changes the member's benefit moving forward, but it also, they could owe an overpayment, especially if they've been retired a long time. That could be a substantial overpayment that they owe. So I'm going to go into more detail about that in the next couple slides. And then also this issue is increased by the employer audits by DRS are not done on a regular basis, and I'll have some more data about how often those occur. And then I should add to have been speaking with DRS about this issue, and so Left 2 staff and DRS do not recall a member who received a recalc requesting to change their survivor option. Instead, member concerns have been regarding the perceived unfairness of the member being on the hook for what was employer reporting error. So 76% of recalcs occurred more than a year after retirement, and 3% of those recalcs in 2018 were more than 5 years old. Spoke with the DRS audit unit, and they provided me some data just yesterday afternoon that there are 497 employers who have never been audited, and that's all employers, not just Left 2. And there are another 685 employers who have not been audited since 2010. And that term audited can vary greatly. That does not necessarily mean that a full audit where they are on, typically they do go on site, conduct an audit, but it was a little unclear about whether that was the term that they were using for when an audit was done, or whether it could be something that was more minor than a on-site full audit. So we had some discussion of this at the last meeting, overpayment responsibility and when the member's responsible and when the employer is responsible. So typically the member's responsible for reportable compensation errors, and these were the ones that were mostly included in the recalc data that we looked at. The employer is responsible for retirement status and separation errors. And this is more of an issue with the other plans with their retiree return to work rules. And what they're required typically to do under those laws is they have to, when they hire someone, they have to verify their retirement status at that time. And if they fail to do that correctly, then they could be on the hook for any overpayments that member receives while working for them. And I did verify, so I'd shared those couple examples of kind of the worst case scenarios of the recalcs done in 2018. And I did verify with DRS in those specific examples, it was the member on the hook for the overpayment, not the employer, that those were reportable compensation errors. And so once again, that means the member took a reduction in their benefit to pay back the overpayment on top of their benefit being reduced to the amount it should have been because of the employer's error in reportable compensation. And then there was also a question at the last meeting about a statute of limitations, and so I went back and verified that and spoke with DRS about how that's applied. And so there is a 3-year statute of limitation, but it's for billing the member or employer for an overpayment. From the time they discover the error. So when DRS discovers there's been an error, they have a statute of limitations of 3 years to bill the member or employer. But that bill can go back 10 plus years. There's no limitation on how far back they can go. So I worked with DRS on one of the, on a real example from the data they provided us for 2018, one of those kind of worst case situations. And so on this one we have, in this example, the employer incorrectly reported 2 areas of pay: cash payments in lieu of employer contributions to Social Security as a fringe benefit, and then payments in lieu of personal leave, which are leave cash outs. And so what we had here was, due to this error, the person's retiree's pension was reduced from $3,164 to $2,843. And then, so they had options to pay that back. One is they pay a lump sum payment to DRS. And then option 2 is they are on an installment plan. And so DRS, I think there are options for an installment plan, but this is just a typical option they give members. 60 months of taking a reduction of $135. And then option 3 is they take an actuarial reduction, which permanently reduces their pension. In this scenario, it would be by $42.49. And yeah, so the member already had their benefit reduced 10%, and then they could have it under option 2. It would be reduced 14% total for 60 months before popping back up to a 10% reduction. Or under option 3, they take a permanent 12% reduction in their benefit. And so here we had OSA didn't have time or the data from us to do a full actuarial analysis, so they provided the following slides. I think they all say OSA on them, to assist the board. We asked them to analyze a bill draft for a second window with 90 days after receipt of a recalculated benefit. So a recalc occurs sometime after someone's retired. They get that new benefit. A window opens for 90 days. It's limited to those who had a change in their benefit of 3% or greater. And the change is prospective only, and the retiree can select any joint and survivor option, including changing to or from a single life annuity. So in this hypothetical example, member with a JNS 100% has a joint and survivor 100% monthly benefit of $4,000, and it's reduced by 6.5%. The 6.5% was the average in the data from 2018, the data provided to us by DRS. The new benefit amount would be $3,740 due to this recalc. And then the member could change their survivor option under this proposal. And so below you see a list of how that change would impact. And so what they were looking at here is the possible intent of this window would be that you could try to get back to what your benefit was. So could you change your joint and survivor option, and that would get you back to the amount of money you were receiving in pension benefit before the recalc occurred. And so you can see under the joint and survivor 50% option, it gets the member pretty close. So they're taking a substantial reduction in the benefit they're leaving their survivor, but it does get their benefit back close to what they were previously receiving before the average recalc was done. And then the other example that OSA looked at was a member with a single life, or was a member who received a benefit increase. And so if a member has an increase in their benefit due to a recalc, can they purchase a joint and survivor option and keep their monthly benefit about the same? So here they looked at same thing, member monthly benefit $4,000, except it's increased by 6.5%, raising their total pension benefit to $4,260. And then below is a chart of their options. And so they could choose a joint and survivor 50% option, and that would get them in the ballpark of what they were previously receiving, except that now it leaves their survivor a benefit where previously they were not leaving a survivor benefit at all. So conclusions from OSA examples. The costs could emerge to the plan if the members re-elect a larger joint and survivor benefit, and they do this especially once, we talk about anti-selection risk, once they have more long-term health knowledge about themselves and their survivors. But also there could be savings if more members re-elect a single life and then end up passing away prior to a surviving spouse. So they were leaving a survivor benefit, they change it, and they end up passing away before their survivor. And then just to add once again, OSA has not completed an actuarial analysis of this proposal, and they would prepare a formal fiscal note if there was a proposal during session. That gets us to our policy options. And so the first option here is for a window for all left to retirees. And this is the first window we discussed, which is the at the time of retirement. So at the time of retirement, option A, after receipt of the first pension payment, there would be a window under policy option 1A. That would be a 60-day window, B, a 90-day window, and C, a 120-day window. This was the one that OSA had looked at, B, a 90-day window, and there would be no material impact to the plan.
Steve?
Now, I know if we looked at this as a legislative option, we would probably not just focus on left two. Do we know how things would change if it was over the entire system? And I have a feeling it would be different assumptions for those different plans in slight ways. And would that have an impact?
So we did not have OSA look at that issue. I do know for the second policy, the second window we were discussing, that I did talk to DRS about that. Should I expect that the recalc data for left two, would that be different for the other plans? And they didn't do an analysis of the data, but they did believe, kind of anecdotally, that there were a greater percentage of recalcs done for left two than the other plans, so there might be a larger impact on left two than the other systems, but not something we've had OSA analyze. Okay. And then second window, so policy option 2, a qualifying event window, and so this would be if a recalc occurs over a certain threshold, that then after receipt of that benefit, the member can change their joint and survivor option. Option A, any change in benefit amount. B, 3%, which was what we had OSA analyze, and then C, 5%. There was a third option that we had discussed previously, which was to include some further anti-selection risk to option 2. And so this would be if a member's change in benefit is that it goes down, decreases, then they can only choose a lesser joint and survivor option, not a larger joint and survivor option. And then same if their benefit, and it matches whether their benefit goes up or down. And so that would just help further limit anti-selection risk. We're not able to work with OSA to identify what exactly the cost savings would be on that, but they did identify it as an option that would help mitigate some of that risk for the second window. And so the next steps, the board can endorse one or more of the policy options. And I did want to include on here, if the board does choose to do that, would the board consider an amendment during session, adding other plans to the bill to be a friendly amendment? or the board could choose to do nothing further at this time and direct staff to continue to study the underlying issues of the policy options for the next interim. So,
Pat?
Mr. Chair, I'd entertain a motion for the policy one due to the fact that what we're looking to do here is let people see what they may or may not make the intention of their option without having to know what their check is coming in. So, and I think that's what we're looking at. And I'd move policy option one with the 90-day window period.
Motion's been made and seconded to adopt policy option number one, which is the 90 days. And as Jacob mentioned, part of that motion, just that friendly.
Yep.
Got it. Okay.
Yes, sir.
Discussion on the 90-day option. Seeing none, all those in favor say aye.
Aye.
Opposed? All right.
Thank you.
Policy one.
I appreciate it.
Right.
Now for the others, because I think, if I understand what Jacob is saying.
Sorry, I can't hear you.
We need more information on policy option 2 and policy option 3. Is that correct? So based on that, I would just, like to make a motion for us to wait till we get additional information on those before we do anything on those.
Is there a second? Motion's been made and seconded to just hold off on policy 2 and 3 until we get more information.
So, are we going to walk back what we just did?
No.
And what is the difference between?
Oh, go ahead.
You adopted a motion to recommend a bill doing the first window.
Oh, okay, got it.
Now you're considering the issue of the second issue of the second window, and you're asking us to bring back additional information to you next interim.
Okay.
Before you have a motion, further discussion? Go ahead, Steve.
I mean, maybe I'm just thinking about from the legislative perspective, is it, if we do have a bill that is dropped and we could get some fiscal analysis done on these other pieces, if those came up and then were peeled off, if necessary, is that a possible direction to go? Or, I think we have talked about these options quite a bit and looked at some of the alternatives and the impacts. But, just from my perspective, we've been working on this for at least the last 2 interims. Now, we can keep looking at it, or we can start getting some analysis done on the fiscal side, and just wanted to see what people were thinking.
Mr. Chair.
Go ahead, Pat.
I guess what the option one policy option one was because we had people that were getting checks and then all of a sudden realizing that they picked the wrong option. It was going to financially hurt them when they had to go back. So what I was trying to do is in that first 90-day period is somebody actually has the ability to look at it. And what I saw from the policy option and the cost of right now, the cost of option one is de minimis. If we go to option 2 or 3, there is going to be financial issues with it, and I think this one is the cleanest one we can push forward, especially with the legislature on the idea of the cost analysis on it. Where if all of a sudden we get bogged down into 2 and 3, and there's going to be costs due to the fact that PERS is more expensive with what they're doing. As we all know, is that if all of a sudden the session is the short one or even the long one, and there's a lot of bills that are coming out, and this one becomes a bill that becomes more of an adjutant than something that's positive, they'll kill this one, and then they'll move on to something more important to other groups. This one I think is very clean. This one looks very clean on what we're asking them to do, where the other one gets into different, through audits and all the other things, on whether they're going to be able to increase or decrease their benefits. And as you know, one question will lead to 10 questions. So I believe that this one is the cleanest one that we put a bill for. And if Ade wants us to do another interim to look at 2 and 3, I'd be happy with that too. but not to have it out there hanging to where somebody can use it to kill this one if we get a bill going. So I've watched the legislature work before, and there's a lot of bills that come up, and they need to cut to the quick, and sometimes good bills get tossed because there's just too much question within that bill and not enough time to answer the questions.
Okay, the way the motions that you just voted provide is the bill will go out with the 90-day window from when you get your first check to change your option. The idea about other plans, that there would maybe be a potentially a different assumption used by other plans than used for left to. The only key assumption in this one is that anti-selection risk of members having additional health or knowledge within that 90 days. And under this, and that's unlikely to be different from one plan to the other. So now the second one, the problem with analyzing or coming up with a recommendation with that one right now is we don't have good data. We got the what data we got last month was different from what we had been getting, and it's, as Jacob mentioned, it's a small data set. It doesn't include the other plans. It's, in my opinion, it's extremely unlikely that any new data is going to come up during session. This would be the type of issue that, especially for the other plans, that the Select Committee on Pension Policy and the board could work together on next year. Now, the Select Committee didn't want to work on the first window this year. I don't know if they're going to want to work on the second window next year, but we could ask them that at the start of next interim.
Quick follow-up. Did we decide if we were going to leave open the language to accept other?
My understanding of the motion was, and I appreciate that discussion that Jacob brought up because it happens during session. I'll be up testifying on your bill, and there'll be an amendment to add the other plans, and they're like, well, what does the board think about that? And you guys don't have a chance to meet during session to answer legislative questions like that. So to the extent that you think about it ahead of time and give us direction ahead of time, my understanding was the motion included that a amendment to add the other plans would be considered a friendly amendment. So that's the way I would testify.
Yeah, speaking in support of the measure, as a follow-up, on Appendix A, what we're looking at, this kind of question to Jacob is, we're not reinventing a bill, we are essentially, where to go here? We're amending an RCW, correct?
Yes.
Right. And so in order to amend that RCW, and this be a question for you, Steve, is in regards to the addition of the language down in subparagraph 6, is that going to require any type of fiscal information in regards to what Representative Berquist was asking?
Yeah, there'll be a fiscal note prepared by the actuary's office on this bill during session. And then if the bill is amended to include the other plans, there'll be a fiscal note on the amendment and the amended bill as well.
Okay, thank you.
Mark?
So the motion that's currently before us is to have the board continue to study policy options 2 and/or 3 over the next interim, correct?
That's correct.
So we're not proposing legislation.
That is correct. Discussion on the motion? Seeing none, all those in favor say aye. Aye. Opposed? Motion carries. Thank you. All right, and I know our time is somewhat short for a couple of our members. We're just going to jump into the interrupted military service credit, and I probably imagine you'll be excusing yourselves probably right after that or before that, your choice. So I know Aday's got to leave. We do have enough people, Aday's got some family things he needs to take care of, and I appreciate him being here today. So, okay. All right, we'll jump into item number 8, which is the interrupted military service credit. And Jacob,
Again.
you guys should just sit there. Right.
Okay.
Thank you, sir.
So the issue here, for purposes of receiving no-cost interruptive military service credit, the legislature has attempted to distinguish between service in combat zones and other types of service. However, state law has continually resulted in inequities, as not all service in combat zone qualifies for no-cost interruptive military service credit. So the status on this issue is that the board received a comprehensive report at the September meeting, and at that time requested a final report with policy option, with an analysis of a policy option to expand no-cost interruptive military service credit to expeditionary medals, and to simplify the language of the law so that it doesn't need to be updated every time there's a new medal created. So, a member qualifies for this benefit when a leave of absence is taken from a DRS-covered position to serve in the military. There's two types of interruptive military service. There is fully subsidized, which is known as no cost, which I don't really like that name since there is a cost to someone, and then a partially subsidized, and so I should add the no cost, who it's paid for is the plan members and employers, the system. For the partially subsidized, what's subsidized is the interest. So the member pays the member and employer contributions, but they do not pay interest. That is subsidized by the plan. So in 2009, the Left 2 Board and the Select Committee endorsed legislation which created this benefit. Under that law, it piggybacked on an existing definition of veteran. The original law defining period of war was actually, under veteran, there's a definition of period of war. That was originally passed in 1969 and is used for other personnel-related benefits. And so under this definition, the member must meet the definition of veteran. There's a list of wars they could have been in, and then in more modern times, the issue has been that it specifies military operations where the member earned a campaign badge or medal. And so the Department of Defense awards a campaign badge or medal to service members who served during a specified conflict and were stationed in a designated war zone. And the law has to identify both, or the way the law has been written so far, it has to identify both the specified conflict and the designated war zone. So there are 4 different categories of medals. Campaign medal and expeditionary medal are the 2 that we've been discussing here. There are also deployed service medals and individual service medals. The eligibility is based, for one of these medals, is based on the service member's degree of personal risk. For example, their proximity to the enemy, their service in a combat zone, and the imminent threat of hostilities, the degree of personal hardship, their participation in designated military operations, and the extent of military service during specified time periods, duration, or types of duty. Kind of trying to break it down into easier to understand language, a campaign medal is typically awarded when someone is in a combat zone, and an expeditionary medal is typically awarded when someone is in support of those combat operations. So the issues here, more specific issues, are that there are military campaigns which qualify for campaign medals that are not currently identified in state law. One of those is the Kosovo campaign medal, and there are 10 qualifying campaigns and operations that are not identified in law. And then just since the last time I gave one of these presentations, there's a new medal, which really highlights the issue here. And this one is this one's interesting, the Remote Combat Effects Campaign Medal. And so this is for people who operate drones. So this is a completely different type of campaign medal. And so far, there are 4 qualifying campaigns and operations that have been identified as meeting the criteria for this medal. So the state veteran definition specifies these individual military conflicts and designated war zones, meaning that the definition has to be continually updated in order to keep the policy consistent every time there is a change on the federal level. The definition, like I mentioned, the definition is located in a general personnel statute, and not Left 2 retirement statute, meaning that updating it impacts more than just Left 2. So we worked with OSA to review the proposal to expand to expeditionary metals. OSA, at our request, broke that analysis into 3 components. The first component they looked at was the estimated cost of reimbursing members who paid for the partially subsidized interruptive military service credit. So they've already done this. They didn't qualify for the no cost, and they chose to purchase the partially subsidized credit. So they looked at the cost of reimbursing those members. And so there you see the breakdown of the rate impact and the 25-year cost. This component alone does not result in a supplemental contribution rate increase. And I should say that OSA, the data that DRS had on these members who paid for it, it didn't identify whether they actually received an expeditionary medal. We just knew they didn't qualify under the campaign medal. So OSA went ahead and assumed that they would all qualify, that they all received an expeditionary medal and would then qualify. So the cost may actually be less than this if not all of them meet that qualification. So component 2, the estimated cost impact of providing no-cost interruptive military service credit prospectively. So this would just be moving forward for military service that occurs after the bill has passed. Have the rate impact and then the 25-year cost being at $1.3 million for the employer. Once again, this component alone does not result in a supplemental contribution rate increase. And the actual amount is largely unknown because it's dependent on what future military engagements there are and the level of service that occurs in those.
Thanks. When you're saying future, is there any past experience that they have not taken advantage of purchasing? Could they also do that, or is there a
That's
slide
component
coming?
3.
Okay, and then the other question is, if this expands to all plans, is this are we a large piece of that pie, or what percentage kind of are we of the military medals category?
Yeah, so once again, I don't have the percentage, but I do know that Left 2 has a greater overall percentage of members who did serve in the military, so it would have a larger impact on Left 2 than the other systems and plans. Perfect lead into component 3. So this is the estimated cost of providing the no-cost service credit on a retroactive basis to members who did not pay. So this cuts out the ones who did pay for the partially subsidized. And this one proved difficult to get data to cost out. So there was not a data source that OSA could rely on to quantify how many members might meet the criteria under this component. So it would be an indeterminate cost. However, OSA did say that compared to the second component of this proposal, that they expect the cost of this benefit to be smaller overall. As a reminder, the previous one, there was not an expected rate impact. So none of these 3 components alone would result in a rate increase. And OSA, can't remember their exact language, but that it would be unlikely that all 3 components together would cause a rate increase. However, there is this real unknown for this third component of how many people already have existing service that would qualify for this benefit. We have worked with Veterans Affairs, DRS, Department of Military over the last couple of years trying to identify some data source. Also worked with OFM, looking at some data sources they had, and so far come up empty on finding something that will work for OSA on that. So policy option 1 is to simply just move and simplify the definition. And this is to avoid the continual need for updates to the statute. It would move the definition of veteran under the Left 2 statutes and rewrite to include all past and future armed conflicts where campaign badges are awarded. So instead of identifying each operation, you would just say that if they set the level at you're awarded a campaign badge, then you qualify for this benefit, and would result in this statute not needing to be updated on such a regular basis. Option 2 is to expand to include expeditionary medals. Once again, this would move the definition to the Left 2 statute and rewrite as I described before, except it would change it to either a campaign badge or a expeditionary medal. There would be, if the board does move forward with this option, there would be a couple questions we would need answered to help draft this proposal. Should members who purchased partially subsidized interruptive military service credit, who now qualify, be refunded the money? We assume the answer would be yes, which is why we had OSA price that component out. And then the second one is, should the change in law apply to retirees? So if you've already retired, should your benefit be recalculated and get that new service credit and changed moving forward after the effective date of the bill? And then option 3 is to just update the existing statute the way we have been doing in the past, which is to add these newly identified armed conflicts to the existing statute. One issue with this is that, as I said, this impacts all the pension systems and plans and others who have laws that point to that statute. So we would either need to make changes so that it only impacts Left 2, or work with stakeholder groups in those areas to see if they also would support that. So next steps are to either take no action at this time, or the board can vote to endorse one or more of the policy options. And then once again, would the board consider, as this is a benefit that seems likely that other systems and plans may be interested in, would the board consider an amendment for other plans to be considered, any amendments to be considered friendly, adding other systems and plans? That completes my presentation.
Thank you, Mr. Chair. Just a question on option number 2. You actually have a contribution rate change of 0.23 of a basis point. By the way, I've never seen contribution rates carried 4 places to the right of a decimal point before. That's innovative. Anyway, so does that assume the answer is yes to both of the questions?
Yes to the first one, and yes to both.
Okay. So we have, for option 1 and 2, we actually have a total exposure of 0.28 of 1 basis point.
Yes.
0.28, yeah, quarter of a basis point.
Again, taking into consideration the no data.
That's not number 3. That's just 1 and 2.
So that is for option 2. So option 2, it's confusing because we broke down the pricing into 3 components, but those 3 components are for option 2.
All right.
So it's
option 1 is 5 thousandths of a basis point, 3 zeros and a 5. Then option 2 is 23 hundredths. So you add them both up and you end up with 5 hundredths of a basis point. So it'd be 28 hundredths of a basis point total for 1 and 2.
For option 2. So all of those costs were for option 2, not option 1. So we did not actually identify the cost of option 1. Option 1 is just continuing with the existing policy, but there are these additional conflicts that have been that are not identified. And so all the cost work we had OSA do was for option 2, which was expanding the benefit.
Okay, I'm looking at the written material, not your plates here. On that, and you show number 1 is 5 thousandths, and then number 2 is 23 hundredths on that. So that total aggregate between the two would be 28 hundredths of 1 basis point if you add them together. Lisa, am I close on this?
Yes, that's correct. Each of these options was priced separately. So if you were doing policy option 1 to reimburse those amounts,
right.
That would be it's 0.2 million
right.
Cost. And then if you also did policy option 2, right. Then you have those additional costs. So yes, they're separate. And sometimes when we put different components together, there's interaction. and sometimes it can change the cost, but we don't think there's interaction with these, so yes, you could just add those together. For policy option 1, the numbers that Jacob shared, policy option 2, those numbers. If you want to do both of them, you'd add them together.
So I understand that's components 1 and 2, not policies. So components 1, 2, and 3 of option 2. So option 2 is to expand to include expeditionary metals.
Is that what you were asking?
I was asking for contributions. You have 3 options listed here, 1, 2, and 3. Option 1 has reimbursed past members' contributions related to military service credit. Option 2 is provide no-cost military service credit on a prospective basis to eligible. So one's past, other's prospective on that. You add them up, 2,300s for one, 5,000s for the other. Your 2,800s for the total cost out the door for number 1 and 2. And anything like a quarter of a basis point basically doesn't change contribution rates. Correct?
That's correct. It wouldn't trigger what we call a supplemental rate.
Right.
But there are still costs. So the reason we put all those decimal places in their contribution rate is to show you that there is a cost, and that's why we have fiscal impacts, the other numbers that Jacob shared. Yes.
Perfect. Thank you.
AJ?
Is policy option 2, is that the one, can you go to that? 2. That's the one where we don't have enough data on this to truly know how many people would be affected?
So this is the one that was broken. This is where we're getting confused with language. Is there's 3 components. So OSA analyzed 3 components to option 2. They broke that down into 3 different components because of the difficulty in pricing those. So some of those components they could price, and the third component of that is unknown, which is the past service. So those that have already served in the military, earned an expeditionary medal, we can't identify who they are, how many of them are out there, and so what that cost is.
Anecdotally, as an example that might help, there is an expeditionary medal that is awarded for the global war on terrorism. And that has been available since 9/11. And we were trying to get data because our understanding was virtually everyone who's been in the military since 9/11 gets a Global War on Combat Expeditionary Medal. And so would that mean that you're providing now free service to everybody that's been in the military since 9/11? And we were unable to get the data or the clarification on that piece of it. We don't know how many left members have Global War on Terror expeditionary medals. There's no data base that that discusses that. So that's kind of the big unknown about expanding it. We know that there's 30 some odd different expeditionary conflicts that are out there going back to the Korean War. We don't know how many left members participated in any of those conflicts. We've got a very small subset. We know how many bought their service credit, and we assumed, for purposes of this analysis, that they bought it during an expeditionary period, and they would now get the reimbursement. That's that first component of the second option. But that third component of the retroactive application, we don't know.
Follow-up, Mr. Chair?
Yeah, please.
So my conclusion could be simplistic, is that if we move forward component 1 and 2 on this, we'll actually be providing an additional benefit to military members from Left 2 out there without actually directly affecting contribution rates at this point. It's de minimis.
So I'd say based on the analysis OSA did, that is correct. However, it was indeterminate what that third component of the second option of that we're talking about, that past service. They did not expect there to be a impact from it, but it's indeterminate.
Steve?
Okay, yeah, so I think I'm understanding that if I don't see us doing components 1 and 2 without 3, and the unknown still is 3, but the actuary's office is somewhat confident that it is not like doubling the other component 1 and 2? That's what I'm trying to get a read on.
Well, we would love to have some data. It'd be probably pretty easy to price it if we could get some data. Unfortunately, we have no idea, how many people would have any of this service. But we don't expect the past to be even as big as the prospective. So we expect that even if you did all three,
It'll be under
that
half
it wouldn't
a
be
basis point.
It wouldn't be a supplemental rate. It's still a cost. Anything is a cost.
Right.
If you're improving benefits, there are costs. So there will be costs shown in a fiscal note, but we don't expect it to be a supplemental rate, which is usually the piece that gets the most attention during a legislative session.
AJ?
So, talking to Mark, it seems to me that the responsible thing to do would be number one. This board has never put forward a bill that we didn't know the true cost of. Does that make sense?
That's the question that the legislators are going to ask.
Are you still going?
No, go ahead.
Go ahead, Jason.
So in the spirit of thinking out loud here, so this has to be written into a bill, and this has to go to the legislators. And if moving outside of anything other than option one, I think convolutes the process, and essentially with the lack of data and the nebulous nature of, A and B, my concern is that's going to cause concern for legislators when it comes to passing through when you don't have all the data that maybe you'd want. Option one seems like the clearest path forward to get it changed, to get to where we need to be in order to, benefit our members and these folks that are volunteering to put themselves, in situations that is, affecting their ability to have and earn a retirement, and it seems like the easiest path forward. Additionally, if we do adopt option one, it seems that would open up a path in the future if we need to, if we do get a bill passed, to amend it for any of these other options. But there are two legislators here that may be able to speak to that.
Steve?
I'm just, we're putting some fairly significant policy things before the legislature this year already. In a short session, without the other pensions kind of playing a role in this, is this something that we're, going to be having as one of our number one policy priorities? How much do we want to stretch our legislative muscles in a short session? It's kind of what I'm thinking about. I don't know if Senator Holy has a different thought, but just trying.
We only have half the volume we do in the House. No worries here. You make a point.
I just think it would be nice to, have the other pensions on board, because I think long term it shouldn't just be a left to statute piece, right? It would probably be for all pensions, and if they're not playing in it this year, is there a benefit to waiting to see if they will participate and kind of help carry the load?
Yeah, on the first part, the policy option one, what I consider kind of the technical correction, for lack of a better word, the select committee chose not to coordinate on that. The second option two, expanding it, wasn't even something that was presented to them for coordination. So that'd be something that, again, could go to them next interim to see if they're interested in trying to get a better understanding of what all the expansion of this benefit would involve.
Question? Okay. AJ?
I'd like to make a motion.
Go ahead.
We adopt option one, policy option one.
Motion's been made and seconded to adopt policy option number one. Discussion? All those in favor say aye.
Aye.
Opposed? Motion carries.
As a point of clarification,
Friendly amendment?
yeah, are you guys okay with me testifying that that would be a friendly amendment if that comes up to do a technical correction for all the plans?
We're good? Yes. Yeah, yeah.
Amen.
Okay.
Right.
And I promise next time I will do component A, B, and C instead of 1, 2, 3, 1, 2, 3.
So noted. Yeah. Right. It looks like we are, I'll let you decide how you want to do this. You want to go to the trustees' attendance policy, or do you want to go on your administrative report? I'll let you decide. It's up to
Oh, let's go ahead and take care of
the meat and potatoes?
Yeah, the admin updates, 3 minutes.
Okay, all righty. Number 9, trustee attendance policy. Afternoon now, Tim. Hey.
Good afternoon, members of the board. For the record, Tim Valencia, Deputy Director for the Left 2 Board. This is Agenda Item 9, Attendance Policy. You will recall that we did review some draft content at the October board meeting, and you had the opportunity to provide us some feedback. That has been incorporated into today's presentation, and we'll move forward from there. So, in overview, trustees, when they come into a role in a public employee plan, they have a significant amount of responsibilities put upon them, and leading public systems have created, by way of best practice, education policies that are intent on giving trustees the knowledge and understanding necessary to evaluate complex proposals and the needs of the systems. These types of policies also help immunize the plan against efforts from outside influences which may not have the best interests of the plan in place. Now, you do have an existing my apologies, this is the wrong presentation. Sorry for this momentary delay. There we go. My apologies for that. So you do have an existing policy in place regarding education. However, the current policy is focused primarily or limited primarily to just a statement about.
Hey, Tim, real
Tim,
quick.
you were on the correct one.
Was I on the right one? Oh,
The
my
attendance
apologies.
policy was what
You're
was
right.
brought
I have
up.
it. I had it wrong in my notebook. I had it backwards. Never mind.
We're flexible. We can go either.
This is why.
Let us know what you want to do.
Sorry, guys.
All right.
Well, let me reset. Back to the attendance policy.
Got it. Thank you.
An attendance policy, again, was also reviewed at the October meeting. It is considered a best practice among leading pension systems. Things that are generally included in a best practice attendance policy include statements along the necessity of attending meetings, but also what it means to be prepared for meetings, communication and notification about attendance, and accountability. That often it takes the form of defining, what it means to have good attendance and what happens when there is an issue with attendance. Under the draft policy that has been provided for you, it does state that regular attendance is essential and necessary for the board to be able to conduct its business. It's necessary in that it allows the board members to share their knowledge and their professional experience from their different roles and different professional capacities, which provides much better discussion and representation of points of view and complete development of policies. The other thing that it helps address is, of course, the meeting quorum issue, which is directly impacts the effectiveness of the board. When we don't have a quorum, the board is unable to take any actions and further their objectives. So that's acknowledged within this policy. The specific elements that are included in this attendance policy note that the part of attendance includes being prepared for the meetings, which includes reviewing agendas beforehand, pre-reviewing materials before meetings, and also the supporting documentation. This policy has an expectation that members will make a reasonable effort to attend at least half of the regularly scheduled meetings during the year. Now, when I say regularly scheduled meetings, what we have generally defined that as are the meetings that are conducted not during the legislative sessions. So those are the full meetings, such as today, which are conducted in person, here at the board offices. We've always included teleconferencing or video conferencing into these meetings as kind of that as participation in the meetings. We're not counting the participation in the virtual meetings, which are the legislative and administrative update meetings, which are conducted during the legislative session. So again, half of the regularly scheduled meetings is the expectation under this policy. This policy does expect board members to, once the calendar is made available of meetings each year, that they will, plan to attend those meetings and identify any conflicts early, and then also protect their calendar to help ensure their attendance at board meetings. There is an expectation to notify staff in advance if you're unable to attend a meeting. The policy does recognize, and the board has always recognized, that there may be circumstances, such as with Trina Day, where you may not be able to attend a meeting. The expectation, though, is to provide notification when you can't attend, whenever possible. And that generally, that when circumstances occur, those and proper notification is provided, that those will be considered excused absences. Now, from an accountability standpoint, we do record attendance in the meetings, and the minutes of all your meetings are publicly maintained on the website, so they are viewable by any interested parties. Under this policy, we would also provide notification to the governor's office or any of your represented stakeholders prior to reappointment or upon any request. So in the last component, talks to what if there is an issue. So first, defining what is an issue. Under this policy, what defines an attendance issue is if you miss 3 meetings in a row without proper notification of the absence, or if you miss more than half of the regular board meetings in a 12-month period. If either of those circumstances occur, the response is that the chair will contact the member to discuss the attendance issue. The response will be shared by the chair to the entire board, and then the board has the opportunity to decide what, if any, action is taken with regard to the attendance issue. So that summarizes the key components of the attendance policy in front of you. That is available for you to adopt as a board policy today if you so wish. Happy to take any questions.
I have one question. What can the board do? I mean, I'm just curious. I mean, it says we can, obviously I would reach out, have a conversation, we would talk about it at the board level to next meeting, and then it says the board can decide what action to take. I'm just curious, what can we do? I don't know what that looks like.
The type of, you can't remove a board member.
Okay, that's okay.
Okay, so that, just to be clear about that, the appointments are made by the governor's office. You could potentially notify the appointing agency, whether it's the State Council of Firefighters, whether it's WACOPS, whether it's the Association of Counties or the legislature about the issue. You could notify the governor's office about the issue. That might be, off the top of my head, the extent of the type of thing that you could do, but clearly removal of a board member is not within your authority.
Okay.
Yeah, I have, in looking at other systems, I did see in some systems where part of the resolution was the request, in a formal action, a request of the board to the member to submit their resignation voluntarily as well. So those are the kinds of actions, but yeah.
Okay, thank you. Questions further? None? I would entertain a motion.
Motion to adopt the attendance policy.
Motion's been made and seconded to adopt the attendance policy as presented. Discussion? None? All those in favor say aye.
Aye.
Opposed? Okay. Those who are not here, we'll let them know. I know. I can't help myself sometimes, sorry. All right. Tim, number 10. Or number 9, whichever one you want to do. Yeah, it's up to you.
Well, I'll just apparently I'm confused by numbers.
It's really up to you. You're going to the 7? Great.
So I'm just going to read from the script here. So back to the education policy again. Reviewed some draft language in October, which the draft language that you reviewed in October is largely still in place in this in what you're seeing before you today. Again, an education policy is considered a governance best practice due to the demands on a trustee. Particularly, you have an immediate responsibility as a trustee when you come to a position on a public fund. So this is certainly seen as something that helps trustees, gives them the ability to develop knowledge and understanding, to help them evaluate effectively the complex issues, such as you saw example of today with all the actuarial work. And again, it does help immunize the system from folks that may be scrutinizing your system and may have intents that are beyond the best purposes of the plan members. There is also, in terms of transparency and accountability, this kind of policy can also help when people are considering participation on this board. It allows them to understand the expectations and perhaps requirements in terms of their time and participation. So as I had started to say, you do have an existing education policy, but it is a relatively narrow policy and largely beyond the statement of the necessity for fiduciary and trustee training, focuses largely on the procedures and requirements for conditions for traveling and reimbursement to board meetings and other educational sessions. So under this proposed amendment to that policy, what is added are the more detailed expectations around the education, and it does so through providing guidelines for the different board members of what would be appropriate training, and also guidance on what are pre-approved programs and from which providers and the appropriate content that should be included in educational pursuits. It also, though, tries to recognize that we know that trustees come from a variety of different backgrounds and experiences, and also have different availabilities and whatnot. So it does seek to recognize the individual circumstances and needs and provide the flexibility such that they can obtain the training and education that they need to fulfill those roles, and not so prescriptive that it makes it onerous on any particular trustee. Looking to the components of the policy. Now, the first paragraph you see up there is the existing purpose statement that remains unchanged, that is currently in place in the policy. So that was not amended in any fashion. The key sentence there being that to fulfill statutory mandated duties as trustees and fiduciaries, board members are required to attend trustee and fiduciary education. And bearing in mind that that's includes a broad statement. For example, today's board meeting, you received a significant amount of education both on investment and actuarial topics. So when that statement was originally crafted, it did take into account such education. What was added were some statements of scope, if you will, such that this policy would be intended to serve as a catalyst for each board member's individual development and advancement to best serve the members and beneficiaries of Left Plan 2. So thus, it does encourage you to develop the knowledge necessary to prudently govern the plan. It does provide a framework for developing the skills and knowledge. It does provide some principles and guidelines for the different trustees to obtain such knowledge, and does, again, tries to be flexible for each individual to meet that education need. So the first element that is added into the formal program is recognition of the board member orientation program. Again, a common best practice. We do have an existing orientation program. This would just formally document what has been our practice. So it is a formal program. It was designed to help bring board members up to speed quickly and provide them the knowledge and information they need to be able to participate as soon as they could and efficiently. The current program includes responsibilities as a trustee, including fiduciary responsibility, board, conducting board business, and state responsibilities as an appointed official. Plan knowledge regarding history of the plan itself and the current provisions of the plan, and administrative information such as how we conduct board meetings, information about the different stakeholders and the partners that we work with, and obtaining education and reimbursements and such. It also does provide that new trustees should be attending the orientation as soon as possible after joining the board, which preferably is prior to their first attendance at a board meeting to help them be able to come into the first board meeting and be effective. Oftentimes it is held in conjunction with their first board meeting, and if not prior to or at the first board meeting, certainly as soon as possible after that first board meeting. So next are the specific guidelines that are contained within the policy. You'll note these are the guidelines in place for the law enforcement members of the board, firefighter members of the board, and the employer members of the board. Within the first term on the board, a board member is expected to complete one approved program. Note there's an asterisk on there. As we discussed in October, there is an exception when somebody is completing a vacated term. There may not be time within their first term to complete any approved programs. There are recommended programs that satisfy this expectation, largely from, and we'll discuss the programs, but the International Foundation of Employee Benefit Plan Annual Conference, the Certificate of Achievement on Pension Policy, the CAP program, sorry, I forgot what that acronym always gets me. But that would be Part 1 and Part 2. The New Trustee Institute from the International Foundation, Level 1 and 2. The NCPERS Annual Conference, the NCPERS Public Safety Conference, and their National Accredited Fiduciary Program, or the NAF program. There are other programs and means to satisfy the expectation, but those are the primary ones that we would expect to be used for that. In second term, a board member would be expected to complete an advanced program. The primary programs that are recommended to satisfy that include the Trustee Master's Program, which is considered an advanced program. You have to have 5 years of experience as a trustee to enter that program. And then also the Trustee Masters Advanced Leadership Summit, which has a prerequisite of having done the Trustee Masters program. So that's why those all fit under the advanced or second term type programs. For third and later subsequent terms, that advanced education may be any of those above programs, or a board member can work with staff directly to try and identify specific areas that they may want additional information, and we can identify programs that might meet those needs. For legislative members who have a shorter term on the board, in their first term, they're encouraged on a voluntary basis to attend or complete one of the education programs. And certainly under subsequent terms, they are encouraged to attend the advanced educational programs as they're able to. This policy does try to provide guidance in terms of how or from whom the trustees can receive or should receive education. So first, we do spell out the educational activities or formats we recognize, even though it's primarily discussed. Conferences is one of the primary ways that education is provided, but there are a host of ways that you may receive appropriate education. Seminars, workshops, roundtables, and other programs. There's also specific courses and programs that may be hosted through academic institutions or other institutions like the International Foundation that have a variety of different programs. Oftentimes we will have in-house presentations, or we may bring programs in-house, or you may pursue education through electronic media such as webinars or online classes or other video-based education, and even relevant periodicals, journals, and textbooks. The board itself has an extensive library. The foundation provides a significant amount of material. So those can all be provided upon request and approval from the director. It also then identifies pre-approved providers and programs. Now, the executive director has the responsibility to approve educational conferences and activities. And when reviewing these programs, and when I say pre-approved, these are programs that we will vet ahead of time to ensure they meet appropriate criteria, such that if somebody's interested in attending those, you will know as a trustee that these are going to be programs that are going to be approved for you. Primarily, though, we're going to look at the actual educational content itself to ensure that it's an appropriate content, demonstrated educational effectiveness, whether or not there are attendance requirements. We know, for example, the foundation, they will issue certificates of attendance when you've met certain thresholds, so that has a good transparency and accountability aspect, and any potential appearance concerns. For example, if conferences are more marketing versus educational, or if there's concerns about the location or nature of the conference itself. Jessica, as the Administrative Service Manager, does maintain a list of pre-approved providers and programs. She does provide that out twice a year. I think the next time will be in January and then likely in the summertime. But that's always available upon request. If there's a program that you're interested in looking at, you can always contact Jessica to obtain that list. The primary pre-approved providers and programs, and these are identified in that policy, are the International Foundation of Employee Benefit Plans and the National Conference on Public Employee Retirement Systems, or NCPERS. With the foundation, their annual conference, the CAP program, the New Trustee Institute, the Trustee Masters program, and the Advanced Leadership Summit are the primary programs that the board has utilized and do a good job of meeting the necessities of a trustee of this system. For NCPERS, their annual conference, their public safety conference, and their accredited fiduciary program, which is 4 modules, also meet all of our pre-approved criteria. But again, other programs may be approved by the director. And lastly, if you are looking and considering programs, we did provide some guidelines in this policy about the content domain that you should be considering. Now, the board has always recognized the value in a broader education rather than specifically pension focused. So many of these topics are seen to provide good value to board members in their broader understanding, and we know that will help in your knowledge of the pension governance. So as this list shows, part of that is pension, but actuarial and investments and benefits, but also regulatory, maybe certifications for your own licensing or other training programs are certainly considered viable under this policy. So in summary, as proposed, this policy is set to encourage trustee participation in education, guided by a framework which is responsive to individual board member needs and meets best practice recommendations for education programs. I'd be happy to take any questions.
Any questions? All right. Entertain a motion to adopt.
Make a motion to adopt the education policy.
Second.
Motion's been made and seconded to adopt the trustee and fiduciary educational policy. Discussion? Yes, sir.
Yeah, just for the record, I want to speak in support of the motion, but also in support of the educational component that was laid out here today by Tim, that I personally, not coming from a pension background or a financial background, have found the courses to be invaluable.
On the motion? Seeing no other discussion, all those in favor say aye.
Aye.
Opposed? Policy is adopted. Just on a matter of housekeeping, we've adopted 2 policies. How are they transmitted, shared with our group so those who are not in attendance know that we do have policies in place?
Right now, they go into our board member, for lack of a better word, manual. They would be shared with new trustees. For existing trustees, they would be notified of your votes today, but we could take that a step further then and send a copy of the new policies to all board members.
Yes, please.
Okay.
Let's do that. Let's email those out. Yeah, that'd be good. All right. Looking at our list, number 11, which is the 2020 meeting calendar adoption. Mr. Nelson.
Mr. Chair, among your materials, I think sitting in front of you was this handout. On the front, it's got the 2020 board meeting dates. That includes all of the board meetings that have been adopted up to this point. On the back of that paper is alternate dates for November. So you'll recall originally the date for November would have been the 25th. Since that was just prior to the Thanksgiving holiday, the board moved it up a week we didn't realize until after the date change that was right in the middle of pre-approved educational conference. So we brought back 4 alternate dates for your consideration where we know this room is available for you in November. So on the back of the calendar sheet, you'll see a November 2020 calendar with 4 dates highlighted. That's the 4th, the 9th, and the 10th, and the 24th. The 4th might be it's a little bit tight because it's only 2 weeks after the October meeting, but the October is an off-site, so theoretically the 4th could still work. The 9th and 10th are shortly before the Veterans Day holiday on the 11th. And then the 24th is still the week of Thanksgiving, but it's 1 day further removed from the Thanksgiving holiday.
For timing, I would prefer to see the 24th, but I'm also thinking of you and traveling. You're coming further than anybody. I'm okay with whatever you want to do, really.
Thanks, Mr. Chair. The obvious one for me would be the 10th, just because that's, it's on a Tuesday kind of a thing here, and it's away from Thanksgiving, and it's, more than 2 weeks from the October meeting. But that's, whatever happens, I'll adjust. I'll make it.
I think the 10th should be fine.
Yeah, sometime during that week there may be caucus meetings or something. It's that's the only thing I'm trying to take in mind.
Fair enough.
It's not good for Jason.
The 4th is the day after elections, so people might be available finally.
Some might
Some
be
might
more
not be
available
here.
than others.
Some might be here in body.
I'm not a senator, so I have to run every 2 years. I don't know how that works over on the other side.
Beautifully.
Yeah. Right.
Nobody really knows how it works over on the other
All
side.
right. Jason said any day but the 10th.
Okay, that leaves the 9th.
9th?
Sure, whatever.
Shoot for the 9th?
Right.
Yeah.
All right, let's shoot for the 9th.
All right, technically, that takes a motion to,
I would entertain, motion's been made and seconded. Oh, is there a second? Sorry.
Second.
Seconded for November 2020 meeting date, moved to November 9th. Discussion on that? Seeing none, all those in favor, say aye. Opposed? All right. Motion carries. Can the new updated calendar, can that also be as an attachment sent out to the entire group?
yes.
I know you'll have it on it's on the website as well, so, but just make sure there's no questions. Great. All right. Thank you for the work there. And I think the last order of our business is the 2-minute, I'm sorry?
Admin update.
Yep, the 2-minute
Yeah.
administrative update. Did you catch how I did that, buddy?
All right.
You said 3, I got you down to 2.
Yeah, I saw that. One quick update then. We've been having an ongoing, we've been working with DRS now for a while on the issue of PTSD. We coordinate with them anytime, Tammy's the ombudsman, so if somebody is having problems with their duty, disability, retirement, she'll be working with DRS, and we've had a number of denials, members applying for retirement and being denied, particularly PTSD cases, and then those cases being overturned after they get out of DRS or when they get independent medical review. So WACOPS and the director of DRS kind of jointly set up a workshop to bring in some people to talk about PTSD with employees from L&I, DRS, and the Left 2 board present. So the idea was at least we were all hearing the same information. Whether that would lead to more accurate decisions or not remains to be seen. The other item I wanted to give you, we still have not received the final approval for the agency move. I'll keep you posted on that. And then the next meeting for the board is scheduled to be January 22nd. And again, that's an electronic meeting during session. We'll just give you an update on what's going on and any admin activities. That concludes my 2-minute admin update.
One quick question. When it comes to the PTSD cases that are being denied, do you have any idea about how many of those are self-insured employers?
No, I'm talking about being denied by DRS.
Oh, okay.
All of them.
Any other questions? Yes. Oh. Anything else for our board before we adjourn? Is there a second? Motion's been made and seconded to adjourn. All in favor, stand up. All in favor, say aye. Opposed? We are adjourned. Thank you.